Hello everyone, this is Bhavik Chokshi over here, and I hope you guys are doing well and studies are going in full swing. Now in today's session we are going to cover the most challenging area in your CFA level 1, that is, well, you've guessed it right, fixed income. Now in terms of the 90 plus readings that are there, fixed income accounts for close to 19 of those readings, and hence in terms of the sheer number of readings it is the biggest. Also in terms of weightage, it's a good 11 to 14% weightage, that is around 20 to 25 MCQs are expected from this section. But more than that, it's a fairly challenging area because a lot of these terms appear to be very technical and concepts appear to be difficult to grasp. So over here, in today's video, we are going to do the entire concept revision, and wherever required, we will also do some numerical application for certain areas, but largely this is kind of a quick revision video for giving you a grasp of the entire subject at one go in the most optimum time. What I'll use is, I will use one of my summary presentation notes. Again, it will be marked over here because there are certain important points that we have discussed in our regular classes, which I want to also cover in the revision classes, some examples over there. So you might see the notes which are a bit marked, but having said that, it does not really matter where you have done because the curriculum remains the same. So this is as good as applicable whether you have studied it only from Shwezar or from the curriculum or from some other faculty's notes or our notes, it does not really matter. It is based on a concept based revision. So when we look at fixed income over here, I would divide this entire section into three distinct parts. First, from reading number 47 all the way till reading number 51. This is the broad introduction. Over here, it's quite manageable and has a bit of theory. The most complex area sits from reading number 52 all the way up to reading number 59, where you are going to do numerical coverage of items like valuation, items like yield, item like spot rate, forward rates, durations, convexity, etc. All of that is covered in this, and I would say this is the heart of your fixed income curriculum. And then from reading number 60 all the way up to reading number 65, where you have again theory which is pertaining to credit risk or asset-backed / mortgage-backed securities, securitization. So in the first 5 readings you will discuss about the basics of bonds and their features across different issuers, different key terms. Then you go into the specifics where you try to calculate the return, yield, duration, risk, etc. And then you go on into credit risk and securitization. Okay, so let's get started. First, we are looking at a fixed income instrument and its features. Before you proceed on to that, certain important understanding of the fixed income. Now, fixed income securities can be any securities which give you kind of a predefined rate of return. It can be a bond, it can be a debenture, it can be a deposit. It gives you something called as interest or coupon, and also gives you your principal back. So over here, when you look at a fixed income security is usually, we can take a most common example of a bond. And what are the features when it comes to a bond? So certain important features. First is the issuer. Who can be the issuer? Well, it can be the government, like these are sovereign bonds, like the US government can issue, the Indian government, etc. These are the issuers. Can be corporates as well, like companies like Reliance, like Tata, like a Tesla might need money and they may raise money. So corporates can be issuers, or there can also be governments. Within governments, it can be kind of the national governments, it can be the state or municipal governments as well, which can issue these bonds. Second is something called as bond maturity. This is when the bond is going to be repaid. Usually in terms of maturities, if the repayment is happening in less than a year, this market is called as a money market. If the bond maturity continues for a period greater than a year, it is called as a capital market. But that is just for an understanding purpose. Usually you can split it as a period less than 1 year as short term or a money market, between 1 to 10 years as an intermediate market and more than 10 years is kind of the long-term market. So over here, this is how you will define the maturity. Maturity is usually stated on the bond and is from the date of its issue. However, sometimes you hear this word as bond tenure or bond tenor. Like for example, if it's a 10-year bond and it was issued 2 years back. So the original maturity of this bond is 10 years, but 2 years have gone by, 8 years are remaining, and hence the remaining tenor or the remaining maturity of this bond will be taken as 8 years. So this is called as the remaining tenor or the time that is remaining to maturity for these instruments. Then there is something called as par value. Par value is the value which is taken as a base for paying interest, also called as coupon, and it is also taken as a base for returning or repaying back the principal as and when it will become due. So par value is kind of the principal base of the bond, and sometimes if let's say the par value is $100, if this bond is trading or is issued at a price above the par value, then it is said to be at a premium. If it is trading at a price below or issued at a price below, it is said to be at a discount, and if it is exactly at par value, then it is kind of a par value bond. Okay. Next, you have coupons. Now, coupons over here are a term which represent the interest that is to be paid. Coupons, it is important to figure out the coupon rate. Sometimes like a zero coupon bond will have no coupon. If there's a coupon bearing bonds, there are coupons. Let's say it's a $100 bond with a 10% coupon, in which case $10 will be the coupon that is to be paid each year, assuming the frequency of coupon is each year. But if the frequency, for example, is semi-annual, which is the most common in case of bonds, in which case your coupon will be paid half yearly, that is $5 of coupon to be paid each half year. Okay, there can be bonds which you can have seniority. When you look at seniority over here would mean bonds which are senior will get money earlier in terms of liquidation, and bonds which are junior will have money, which will receive money later in the stage of liquidation. Bonds which are senior have relatively lesser risk because their money will be received back earlier. Junior bonds have relatively higher risk. Some bonds also have something called as a contingency provision. A contingency provision would mean a provision whereby on happening of certain events or certain actions, you will have to take certain decisions. Like for example, if it's a callable bond, a callable bond would mean that if the issuer decides to call that bond back, then the holder will have to give that bond back and the issuer will pay that back money. So that is a contingency. Or it can also be a puttable bond where a holder has a right on happening of certain event, the holder can put back the bond and hence the issuer will have to pay back money. So there can be various such conditions, but these are various contingency provisions. Now bonds can be issued in various currencies. Like for example, usually if it is issued in the same currency, it's like a domestic bond. Sometimes bonds are also issued in dual currency, that is, for example, interest will be paid in one of the currencies whereas the principal will be paid in the other currency, but these are relatively rare. So this is regarding certain basic features of a bond. A question will also arise that if I am issuing a bond and raising money, how will I repay that money back? From where will I repay the money back? Well, it depends on the type of the issuer. Like for example, if the government is the issuer, then usually government will repay back the money from the taxes that it collects, or new money it will print, or the currency that it will issue. If let us say it is a local government, in which case the money will be repaid back using the local taxes that they can collect, or even if it is linked to a specific project like a toll road, then the collection that you get from that. If it is a corporate bond which is secured, then firstly the money, if there is falling short, will go from the security or the collateral, and later from the other resources in the company. If it's an unsecured, in which case the money will go from the general operations that the business is able to generate. So companies like Byju's, for example, were unable to generate enough cash flows, and hence their bonds, they could not honor their commitments and they default, and there was insolvency. And then at the end of this material, you will study something like an ABS or an asset-backed securities. This is kind of a securitized instrument. For the time being, you can just remember that what happens is, like if there is a bank which has given out various loans, it can kind of bundle up some of these loans and transfer it to a special purpose vehicle, SPV or an SPE as the case may be, and on the collateral, on the back of these assets, This special purpose vehicle will issue new fixed income related securities with tailor-made customized cash flows. So this is called as a customized instrument, tailor-based instrument. We will do that at the end. The last 3 or 4 readings are dedicated to asset-backed securities. So the sources of repayment for the governments, whether local or national, are usually taxes. For corporations are usually their business, and if it is secured, then the nature of security, and if it is an asset-backed security, then usually the cash flows from the collateral. The return that a bond generates is called as yield. Now, yield refers to the return that a bond gives. Now, someone will say that the return that the bond gives is only the coupon. Remember, coupon is a part of the return. For example, one of the most common bonds is a zero coupon bond. Zero coupon bond gives you literally zero coupon, which means does it have a zero return? The answer is no. Why? Because this bond may be issued at $80 and it might redeem at $100, and hence the discount or the premium can also affect the return along with the coupon, and hence there is something called as yield. Yield is a return or something called as the IRR, the internal rate of return that a bond will give. If I were to invest in the bond today, hold it till maturity, for example, then what is the yield? That is called as the yield to maturity. There is a separate section in which we will discuss the yield or the yield to maturity workings. There is something called as a yield curve. Yield curve would mean that a curve where you are plotting the yields against various maturities. Usually the yield curve will plot upwards, that is a normal yield curve. As the longer the maturity, higher will be the yield per annum, because longer the maturity, more the uncertainty, more the risk. That is a normal upward sloping curve. Or the yield might be reducing, which is very rare, but that is called as an inverted yield curve or a downward sloping yield curve. Now, other things in terms of bonds are, there's a bond document called as an indenture. Now, in case of a bond document, there will be various conditions which are put, also called as covenants. Covenants may be affirmative, that is things that an issuer has to do, like pay interest on time, pay the principal on time, do the compliance, etc. These are affirmative covenants which are usually there in most of the issues. And then there will be negative covenants, would mean there would be restrictions. That is, the issuer cannot do, let's say, a buyback, they cannot do an acquisition, they cannot do certain things or pay dividend without the permission of the lender. So these are negative covenants. Remember, the negative covenants will restrict the company. Affirmative covenants are usually things that the company should do, and negative covenants would be the things that company will have to avoid doing. So over here, you will have negative covenants like restrictions on asset sales, additional borrowings, etc. Positive covenants can be more compliance linked, of things that a borrower is agreeing to do. Now, there are a couple of interesting things over here. There's sometimes a cross default clause, which means that a company might have issued 10 different bonds. However, if it defaults on one of these bonds, and if there's a cross default clause included in our bond indenture, that is a bond document, then it will be treated as a default for our bond as well. Like, for example, we have a series B bond, there is another series A bond. However, there is a default in series A, and if there's a cross default clause, then it will also be treated as a default in series B if there's a cross default. Second is a pari passu clause. Pari passu will mean equal rights, which means if there is a pari passu clause, then your claims are equal to claims of other bondholders. You will not enjoy any superiority, nor will they enjoy any superiority. They will have equal rights or equal priority in terms of claims. So that is broadly the essence of your first reading. Next, you have fixed income cash flows and types. So over here, we are looking at the various cash flows. Well, essentially there are two main cash flows. One is the coupon that is paid as per the agreed terms, and then the principal that is written off the par value. Now, usually the type of bonds can be something called as a bullet bond. Bullet bond refers to a bond where the repayment happens in one shot. So, for example, it's a 5-year 10% $100 bond. Then for 5 years there will be 10% of $100, that is $10 of coupon, and then at the end of 5th year, boom, there will be the entire interest, there will be the entire principal. So that is your bullet bonds. Second is amortizing bonds. When we are looking at amortizing bonds, that means the principal and interest, both of them get repaid over a time. It is not just repaid at one bullet shot. Like a fully amortizing bond would be, again, a 5-year 10% fully amortizing bond would be, if it's a $100 bond, then every year $20 of principal would be paid. By the end of the 5th year, the entire amount is paid, and the coupon on whatever is the outstanding principal will also be paid. A partly amortizing bond, on the other hand, would be, like, let's say for a $100 bond, over a period of 5 years, every year you pay $10 of principal along with interest. So you paid $50, remaining $50 you will pay at one shot at the end. So there can be a fully amortizing or a partially amortizing bond. Further, there will be certain bonds with a sinking fund provision, which would mean that there would be a repayment of principal over time with a series of payment depending on your sinking fund or commitment requirements. And there is a floating rate note, or a floating rate note is a bond where your coupons are usually linked to something what they call as MMR, that is the market, or MRN, the market reference rate. So over here, when you look at the market reference rate, it can be, let's say earlier it was something like a LIBOR, London Interbank Offer Rate. Now it is something like a SOFR, the overnight financing rate. So secured overnight financing rate. So it can be various reference rates. However, the interest rate is not fixed. Like in most of the bonds, the coupon or the interest rate is fixed, but in case of a floating rate bond, it is the market reference rate, also called as the MRR, plus the margin. Why? Because a market reference rate is usually for an interbank market. That is, if one banker is borrowing from another banker, then what rate will they lend? However, we are not having the same credit rating as that of a bank, and hence when we go to borrow, depending on our credit rating, they will charge us a separate margin, like SOFR plus 1% or a SOFR plus 2%, for example. Again, the rates can have basis points, like 100 basis points are 1%. So you can be quoted as, let's say, SOFR plus 200 basis points, which means the SOFR plus 2%. Sometimes floating rate notes have a cap, that is your interest will not go beyond this level, and a floor, that is it will not go lower than this level, but that is if it is specifically given. There are some other coupon structures as well, which is like a step-up coupon, which is very common in case of instruments with like infrastructure commitments, where initially the coupon is lower, and then as time passes, the company stabilizes, the coupons will increase. Step-up coupon. Then is credit-linked coupon, which means if your credit rating changes, like today you are AAA, in which case you are getting a 10%, we will pay a 10% coupon, but if our rating falls, it becomes AA or a single A, we'll pay more coupon. So these are credit linked coupons. Again, if our credit rating improves, we'll pay a lesser coupon. So these are credit linked if it is specifically there. Payment in kind bonds would be also called as PIK bonds, PIK, where the interest will be discharged by issuing more bonds. So over here, if there's a $100 bond on which the interest at 10% is $10, in which case I will issue a new bond of $10, and hence these are payment in kind, usually used if company has a difficulty in cash flows in the earlier years, in which case it is issuing more bonds now, but at the end when it will have enough cash flows, it can pay the bonds. Then you have a deferred coupon bond, where you will pay like educational loans, you will have lesser interest in the earlier years, but there will be more interest in the later years. Index linked bonds, most of the times the most common index to link is inflation, because bonds are fixed income instruments and they will get affected by inflation. So over here, sometimes it is inflation index, like inflation, like a consumer price inflation or CPI. Like for example, if the CPI over here, the consumer price inflation is, for example, 110 on an inflation base of 10%, so there's 100 plus 10%, that is 110, in which case your coupon, if coupons are indexed to inflation, then coupons will accordingly be indexed based on inflation. Or there can be capital index bonds, in which case your capital or the principal amount will be indexed as compared to inflation. You will have to see the indexing is on what base. Okay, there can also be green bonds, which are quite popular these days. Green bonds are linked to emissions, etc. So these are bonds which kind of take out a lot of sustainability, ESG goals. So they are linked to emissions, etc. Now, bonds might also have something called contingency provisions. Contingency provisions would mean you'll have to take certain actions if a particular event happens. If the bond has no contingency provision, in which case it is called as a straight bond. However, this bond might have three very common features. If I can pull this up over here, this is a callable bond, puttable bond, or a convertible bond. A callable bond is a bond where the issuer has a right to call back the bond when the issuer wants. Usually the callable bond issue, if it's a fixed interest bond, the issuer will exercise this option when market rates of interest are falling. Now I have issued a bond at a fixed interest of 10%. Now the market rate of interest is around 6 or 7%. I will call back this bond. I don't want to pay 10 when the market rate of interest is 7%. So this bond is adverse for the holder because this will be called back if the market rate of interest is falling. You were having a good bond, but that might be called back. But it is favorable for the issuer. On the other hand, puttable bond will be the exact opposite, where the holder can put back the bond when the holder decides. For a fixed interest bond, typically the holder will do that if the market rates of interest are increasing. I may be holding a 10% bond, today the market rate of interest is 15%. I will put back that bond, get the money so that I can deploy it at 15%. This is the bond which is favorable for the holder, but it is adverse for the issuer. Needless to say, for a puttable bond, the holder will be willing to pay slightly more because it is favorable to the holder. But for a callable bond, the holder will be willing to pay less. So somehow you will try to find a fair value of the callable feature, fair value of the puttable feature. On the straight bond, if I want to find the value of the callable bond, I will deduct the fair value of the callable feature because it is adverse to the holder, and that will give you the net amount the holder should pay for the callable bond. But for a puttable bond, to the fair value of the straight bond, I will add the fair value of the puttable feature to find the value of the puttable bond. Then is convertible bond, where the holder has a right to convert into the issuer's equity. This is also an instrument which is favorable for the holder because the holder can decide to convert if the holder wants, otherwise they will get their assured principal, and hence for convertible bonds, holders are ready to even accept a lower coupon or lower return because they have this possible upside. So we have taken this example over here, like if the fair value of the callable feature was 20 and the non-puttable, non-callable, that is straight bond, was $1,000, then callable bond would be worth 980, that is you will deduct, but a puttable bond would be worth 1000 plus 30, that is 1030. Now in convertible bonds there are three common terms, which is conversion price, conversion value, etc., and conversion ratio. So if the bond has a face value of $1,000 and the conversion ratio is 20:1, 20:1 means one bond will convert into 20 shares, which means each share will effectively cost you $1,000 divided by 20, that is equal to $50 will be the conversion price. Conversion value, well, if the market price of the equity share is, for example, $60, then one bond will convert into 20 shares. If every share is worth 60, then 20 into 60, 1200 will be your conversion value. So over here, this kind of takes care of callable, puttable and convertible bonds. Warrants give the right to buy a specific quantity of bonds at a specified price. It's more like an option. And COCO bonds or contingently convertible bonds will be bonds which convert from debt to common stock on happening of certain events. Like for example, government had certain dues with Vodafone. Vodafone was not able to pay those dues, and that got converted into Vodafone's equity, V Limited's equity. So this is contingently convertible bonds. So conversion will happen if a specific event happens, otherwise they are not convertible. So these are various types. Further, if you are looking at the bond in terms of a global scenario, if there is a US market, a US company issuing bonds to US investor, this is called as a domestic bond. The bonds are going to trade in the US market, it is issued by a US issuer, in which case it is called as a domestic bond. If let us say you want a foreign bond, that means the bond is issued by someone like Standard Chartered, for example, which is a British company, and it is going to be subscribed by Indian investors. Now this is a foreign bond because the bond is kind of traded in a separate country, and it is the issuer is in a separate country, in which case that is a foreign bond. Now, a very interesting bond is called as a Euro bond. Now, Euro bond it gives a wrong impression that these are bonds denominated in euros. That is not necessarily the case. Euro bond means a bond which is issued by a particular company, in a particular country, but its investors in a different country. It is kind of trading in a different country. Like for example, if a Chinese company issues bonds to Japanese investors in, let us say, a different currency, that can be called as a Euro bond, for example. So over here, this is a bond which is issued and traded in a different Chinese company, like BYD issues bonds in Japan, in which case this will become like a Euro bond. However, if this bond is issued in multiple markets. One of those markets is also the domestic market, like China bhi hai and Japan bhi hai, then this can be called as a global bond. So there are 4 types: domestic bonds, where everything is in the same country; global bonds, where issuer different, market of investors different; third is euro bonds, where a different country in a different geography you are issuing, and if it's a global bond, you are issuing in a different geography, but some of the investors are also your local investors, in which case it is called as a global bond. Now, bonds can have a bearer bonds. That means whoever is bearing, like a bearer check, whoever is holding those bonds will be kind of treated as the owner of the bond, or registered bonds, where your name has to be registered for you to be the owner. Most commonly, the bonds are registered bonds. The issuing entities can be various entities, like they can be corporates, they can also be government. As we discussed earlier as well, corporate bonds will be financed by the business cash flow, whereas government bonds will largely be financed by the taxes, etc. that will be there. Secured bonds will have a claim on specific asset. Unsecured bonds will not have a claim on a specific asset, but over the general company. Now, there's also something called as a sukuk bond, which is more of a specific Sharia compliant Islamic bonds, like in Sharia law or as per Islamic law, probably taking interest is haram, and as a result, they would not want a bond which pays them interest on capital. However, they can kind of take rent, and hence these are bonds which will structure the payments not in the form of interest, but this will be payments which are structured, which maybe cash flows in the form of rent on the properties, for example, and hence that may be Sharia compliant, also called as sukuk bonds, which is as per the Islamic law. Okay. Then you have certain other credit enhancements, etc. This is not there in this chapter. We will discuss that in one of the upcoming chapters. When it comes to taxation of the bonds, well, taxation depends on the jurisdiction in which these bonds are, but generally if you look at US, interest is taxed at the ordinary rates, whereas on maturity the premium, etc. that you get is taxed at the capital gains tax rate. Now, the problem arises in case of a zero coupon bond which is issued at $80 and is maturing at $100. So this $20 can either be taxed as capital gains at capital gains tax rate, or maybe it's a 4-year bond and roughly $55 in each of the years can be taken as interest and will be taxed at ordinary rates. We'll have to see how the original issue discount will be taxed depending on the jurisdiction, and these tax rates can possibly be different as well. So that kind of takes care of the next reading, after which we go on into fixed income issuance and trading. Okay, next you have this topic where you are going to discuss about the fixed income issuance. So you have global bond markets. The 3 main distinguishing features are in these global bond markets. Who are the issuers? As we have discussed time and again, the issuers can be corporates, governments or sovereign. They can also be special purpose entities that you will study in securitization or mortgage backed collateral related ABS transactions. So over there, these are the various types of issuers. Credit quality is largely measured by credit rating agencies. Globally, there are 2 very big ones, S&P and Moody's. There is also Fitch, but these give credit ratings. Usually ratings above BBB and above are considered to be investment grade bonds. So the ratings start usually, I mean, different agencies have different, but let us say AAA, then you will have plus minus, then AA, then A, then BBB. Till that, it is investment grade. Below that, that is BB, B, C and D. These are high yield or speculative type of bonds. So usually when you are evaluating the bond market, you will figure out whether this is a investment grade bond, that is BBB and above, or it is a speculative high yield that is below BBB rated bonds, and their yields would be different. Original maturity, well, as we've discussed earlier, for short term or money market less than a year, intermediate is 1 to 10 years, and for capital market or for a long term market, it is more than 10 years. Capital market is generally referred to more than a year, which can be intermediate, which can be long term as well. Now, this is regarding the issuers, but that is one side of the spectrum. On the other side of the spectrum are the investors. Now, who will put in money? Well, obviously the smaller investors are a small function or a small fraction over here, but when we are looking at the larger investors, you will have someone like the pension funds, there will be corporations, there would be financial institutions, banks, etc. They will have different requirements. Now, usually pension funds will invest money in the long-term bonds because they have to pay money over the long period, and hence they will usually, insurance company, pension funds will have long-term investment grade bonds. Corporations will need money for day-to-day working capital, and hence if they have surplus funds, they will typically park it into short-term bonds. Central banks will, depending on their objective, but largely into the intermediate grade categories. There may be bond funds or ETFs, asset managers, financial intermediaries like banks. Again, depending on their objectives, there will be takers at each level. Like you will have takers even for a medium grade bond, which is intermediate maturity, long-term maturity, short-term maturity, etc. Now, when you look at fixed income indexes, like you'll have equity indexes, like the S&P 500 is the equity index. You have the Nasdaq Composite, you will have the Dow Jones Industrial Average. Like you have these equity indexes. Like in bonds also the indexes are there, though they're not as popular, at least from a student or our level, because we largely invest in equity. But there you will be surprised to know that there will be more bond indexes. There are more bond issues as compared to equity issues, because one company can issue one type of equity share. Generally they can have different types of bonds and different, like some can be senior, some can be junior, secured, unsecured, subordinated, and there can be so many different. Government does not issue equity, but government can issue bonds, and hence there are a lot of bonds, and hence there is a lot of bond indexes. They have more constituents, they have more varieties in bond index, and there's a lot more churning, that is removing one, putting in the other in bonds indexes as compared to the equity indexes. There can be aggregate indexes as well, which will aggregate a lot of different bond indexes. Like the Bloomberg Barclays aggregate index will aggregate a lot of individual small bond indexes. Narrower indexes can also be there, which are focused just on a sector or a geography or ESG compliances. Then there is a primary and secondary market. Now, mostly when you look at a bond issue, when it is a primary market will be the market of the fresh, for the first time offering. Now, there may be a company which is a seasoned company, like a Reliance keeps on coming to the bond market every year. So, primary market is the market where you are raising money directly from the investors. If the company is coming in for the first time, this is called as a debut issuer. They can do a public offering where they're raising money from the public at large, or they can raise money from selected institutional investors, which is also called as a private placement. These issues can be underwritten by investment banks. There can be full underwriting, which means the investment bank agrees that if the issue is not subscribed, the investment bank will ensure that even if it has to put its own money, it will put its own money and get it subscribed. On the other hand, it can also be a best issue basis, which means on a best effort basis would mean I will take my best effort, but after the best effort, if the issue does not get subscribed, I'm not going to put in my own money to subscribe it. That is called as a best effort underwriting. Obviously, the commission that the banker will charge for a fully underwritten issue will be higher as compared to best effort basis, where the risk is relatively lower. There can also be a grey market, which is the market before the issue is actually launched. Now, when you look at the secondary market in USA, as it is written over here, most of these issues run through what we call as primary dealers in the over-the-counter market. However, we will also have something like a shelf registration. A shelf registration would mean, like, I will issue a issue document, and based on that document I will keep on coming regularly and raise money. Usually very common with banks, which will need money very regularly. So they will have a prospectus or a draft prospectus, and they will file it with the regulator, and based on that, throughout the year, whenever there is a need of funds, referencing that document, they can raise money. That is called as a shelf registration. Now, in the secondary market, there can be a dealer market or an over-the-counter market. Exchange market is relatively lesser for bonds as compared to equity. It is more of the over-the-counter market, which is there, where if you want to buy or sell the bonds, you approach the dealers, and the dealers will quote bid and ask prices from which you can trade the bonds. Like you do for currencies. There are certain bonds which are on the run bonds. These are relatively recent bonds which are very popular, which has more liquidity, and hence they will have a relatively lower spread. Spread is the difference between bid and ask. As a dealer, if it's a fast moving item, I will be okay having a relatively lower commission. However, if it is a slow moving item, I will need more commission. That is the difference between my bid and ask quotes will be greater for season, that is old issues where there are not much liquidity, but my commission or spread will be lower in case of a recent on the run issue. So that kind of takes care broadly of this fixed income issuance and trading. The next two chapters pertaining to this first section will be fixed income markets for corporate issuers and then for government issuers. That is a theory part at the beginning, then we jump on into the numerical section. Okay, so firstly for corporate issuers, there are two types of corporate issuers. There can be non-financial institutions like companies, Tatas, Reliance, Birlas, etc., or the financial institutions like a bank or an NBFC, for example. So over here, if we can just pull that up, the short-term funding alternatives, let's say for non-financial corporations, usually these non-financial corporations need money for various purposes like working capital, and hence the closest recourse for them is going to banks. And to banks, they can have a line of credit. Now there are three different types of line of credit. There can be an uncommitted line of the credit when I go to a bank and HDFC says, well, you know what, I'm okay lending you up to 50 crores. Whenever you come, I'll be okay to give you 50 crores, but I'm not giving you a commitment, which means when you come and if the times are bad, I might just outright refuse. So this is not a very reliable line of credit. Second is a committed line of credit where HDFC says within 1 year, whenever you want, I'm ready to give you 50 crores. When you come, I will have to give you, and I will have to give you. So that is a much more reliable source of finance. However, that comes with its attached cost, so there will be higher processing fees and transaction costs for a committed line of credit. And last is the most reliable, that is revolving line of credit. That means every 1 year I don't have to go again and again to find a committed line of credit. It is till the time it is cancelled, the revolving line of credit kind of continues, which is the most reliable source of financing. There can be other sources as well, like secured loans, factoring. You can issue commercial paper as well. These are generally highly rated corporates which can issue commercial papers, like the government issues treasury bills, they can issue commercial papers. And then there's something called as bridge financing, which means if I need money for an acquisition, but long-term money is time consuming, for a very short-term period I can raise money, but that is just to meet that immediate liquidity requirement, that is bridge finance. So this is for non-financial corporations. For financial corporations like banks, the best and the cheapest source of money is checking accounts, like your current accounts, or also the saving accounts in India. That is called as CASA ratio, current account and saving account. How much proportion? Because these are the lowest cost. Current account 0%, saving account a very low 2-3% at least in India. So these are lowest cost. Also you can accept deposits like a fixed deposit, which is a relatively higher cost funds. However, these are the most common sources of finance for a financial corporation. Now there is another source which is a repo. Now on repo there can be a possible exam numerical question, and hence we will discuss this quickly with the help of an example. Now what is repo? The full form of repo is repurchase. Now over here this is usually a source for short term funding where I want money, let's say for 15 days. Now one option is I go to a bank, I fill out a big form, do all the paperwork, give some collateral or security. By the time 15 days will be over, I need money very quickly. So what people would do is they will enter into a repo deal. They say that, well, you know what, I have bonds, I can give those bonds to you as a security, but it will be a long pledge, hypothecation, mortgage document to execute. I will sell these bonds. Let us say these are $100 bonds, I'll sell these bonds, and against that you give me money. So actually I'm selling the bond. However, I want money only for a 15-day period. So I say that, well, I will agree to buy back the bonds after 15 days at a predefined rate. Now that predefined rate is today's selling price plus the repo rate of interest. So over here what will happen is, let's say there are bonds worth $1 million in this example and the initial margin is 3%. Why is there a margin? Because, well, when I'm selling the bonds, I'm taking money, I'm in a way taking a loan, and then when I'm repaying that is I'm repurchasing the bond, I'm in a way repaying the loan. However, when you take a housing loan, if the house is worth 100 rupees, the bank does not give you loan of 100 rupees. They will deduct some margin, and if the house is worth 100, the bank will keep a buffer. They will give you a loan of, let's say, 90 rupees. In a similar way, there's a margin, which means on a $1 million loan or a $10 lakh loan, there's a 3% margin, and hence over here, roughly speaking, over here you will have a loan amount which is lower. So what will be the amount? So this is 10 lakhs or 1 million divided by 1.03. So that will give you approximately 9,70,874. That is the amount of loan. Now the repo rate is 2% and the repo days are 90 days considering a 360 day a year. So at the time of repayment, we would agree that on this 9,70,000 at the rate of 2% into 90 by 360, there would be interest, and hence the repurchase price is predefined today only is 9,75,729. So when I'm looking at, for example, this transaction of repo, there would be a $10 lakh bond on which, let's say, 10 lakh divided by 1.03 will be the loan amount, on which you will add 2%, which will be the interest. 2% is per annum. So for 90 days, whatever is the amount, you will calculate, and that will help you in the repo deal. Now, this margin over here can also vary because it is possible that the bond price can change. Loan value will increase due to interest. The bond price can change, and hence, if the margin is falling short, you will have to pay a variation in margin as well, for which some separate calculations may also be needed. So over here, there is some detailing regarding repo. We have discussed this regarding repo. There are various uses in terms of repo. The repo deals would be usually executed faster because there is a collateral or security. The cost would be relatively lower, and the deal will get consummated faster. Again, the cost being lower is always, it's a function of the collateral. If the collateral or the bond that I'm giving is of good quality, the period is relatively lesser, the cost will be lower. But the period is longer, the collateral is of an inferior quality, then there will be a higher rate of interest. So there are a few things about repo which is there in your material that you should read properly. Then you have contrasting the long-term funding of investment grade versus high-yield corporate issuers. Now, when you look at an investment grade issuer, usually for an investment grade issuer, the rate of return will be relatively lower because the investment is safe. But for a high-yield issuer, the rate of interest will be, the return will be higher. But at the same time, what happens is, generally the rate of return is a total of the market rate of return, reference rate, plus, let's say for investment bond 1 to 2%, for a high yield bond 5 to 6%. This is a spread for the higher risk. Now the problem is, if the market is good, then well, things go well. But if the market turns bad, even then in the investment grade bond, the spread widens narrowly, because if the market is bad, these bonds are not necessarily going to default. However, people will panic. In a high yield bond, there will be lesser liquidity, people will panic, and the spread will widen. So if you are holding a high yield bond and the market kind of goes bad, it is possible that the price of the high yield bond falls a lot more as compared to the investment grade bond. So relative to the investment grade bond, high yield debt is likely to have a higher proportion of its yield relating to the credit spread, that is 5 to 6%, greater number of covenants, conditions, especially negative covenants, relatively shorter maturity, more equity-like return, and prepayment options possible. When you look at a high yield investor, the probability of default that can happen, loss given default, all of these are important considerations as compared to the investment grade bonds. Okay, so that is regarding your corporate issues. Then comes to the government issues. Government issues, you will have sovereign bonds which are backed by the national government, backed by the taxing power. Also, they have the highest possible credit rating, and these bonds are considered to be closest to the definition of the risk-free bonds. The most recently issued government bonds are usually the benchmark on the run government bonds, as they call it. Now, when we look at the issuance of government and corporate fixed income securities, there are different types of auctions. Like, there can be a single price auction or a multiple price auction. There can be competitive bidding or non-competitive bidding. So you will try to understand this, let us say, with the help of an example. Okay, for repo, there were a few things. As we said, repo is useful for financial institutions, banks can earn repo rate, can impact monetary policy. There are various factors which are there, rate of interest if there are alternative sources, credit quality. So you can just, it is just discussing the various theory points. Government issuers can be sovereign bonds, non-sovereign bonds. Within sovereign bonds, there can be developed markets. In developed markets, as compared to emerging markets, they have a relatively stable currency. They have clear, transparent policies as against to emerging markets, where the policy changes quite frequently. The currency may not be as stable, and hence emerging market bonds will have a relatively higher yield as compared to the sovereign bonds. In non-sovereign, you will have the government bonds, which can be let's say state or municipality, or agency like a government agency. Like in India, you have LIC, which is a government agency, or in the US, you might have a Ginnie Mae, etc., which is their mortgage agency. So these agencies can also issue bonds. Again, from where will they repay? Well, there can be two types of bonds. There will be a general obligation bonds, where they will repay from the general taxes, etc., that are collected, and there can be a revenue bond, where there is a specific project, and based on the cash flows of that project, the municipality or this government agency will repay. Usually, a general obligation bond is much more safer because it is backed by the general taxing power that the municipality has, and not just linked to what is happening in a particular project. So over here, the public auction process is what we wanted to discuss. When we look at the public auction process, let us say I'll take two bids. One is a non-competitive bid and one is a competitive bid. This is in case of a multiple multiple price auction, let us say, where there can be multiple prices or rates that people can quote. Like I'll take an example of an IPO that you will probably try to bid. Now, as a retail investor, what you would have done at most times is you would have selected the cutoff price, which means, well, IPO is going to happen in a particular price band. I don't have that prowess to do valuation. So whatever is the final cutoff price that is selected, that is the price I will take. That is called as a non-competitive bid. I'm not giving my rate. I'm saying whatever is the final rate, I will accept. Non-competitive bid. In an issue allotment, in the auction process, first allocation will be given to the non-competitive bids because they are accepting whatever is the final rate which is decided. After that, on the competitive bid, now depends on whether the bids are in dollars or bids are in rates. Let's say bids are in rates. So as an issuer, I will prefer to give money to those who have bid the least. So if, for example, there was an issue of $100 million, and these are the various bids that have come through dealers. There are 6 bids at different rates, some at 2.5, 2.4, some at cutoff rate, some at 2.55, some at 2.6. Now over here, if it's a $100 issue, I've received bids worth $120. To whom will I allot? The issue is oversubscribed. I will first allot money to the non-competitive bids. So they are at cutoff price, 40 million will be to the non-competitive bids. There's still 60 million remaining. I will try to give money to those where I have to pay the least interest, which is probably 2.4, that is another $20 million. Then the next will be 2.5, another $30 million. But still I'm at 90. I have to touch 100. Then out of this bid of 25 million at 2.55%, I will give them allotment of $10 million, and thereby my issue is subscribed at 2.55%. So if it's a single price auction, the ultimate yield will be 2.55%. Everyone will receive 2.55% only. But if it's a multi-price auction, then every investor will receive what they have bid. So this 20 million will receive 2.4, this will receive 2.5, this will receive 2.55, and the non-competitive will receive, let's say, the final cutoff rate, that is 2.55%. So if it's a single price auction, 2.5% will be the cutoff yield for everyone. All of them for multiple price, everyone will get their relative respective rates that they have bid for. So these are the type of auctions. There can be public auctions to issue government securities. There can be competitive bids, non-competitive bids. There can be single price auction where everyone pays a single amount, that is 2.55% they will get, or there will be multiple price where they will get the respective amounts. Once issued, the debt will typically trade on the OTC dealer market. Most of the bonds are not exchange traded, they will be traded on the dealer market. The most active price is available for on the run, which are relatively recent bonds. Okay, so that I would say takes care largely of the first section of this fixed income, where you have discussed regarding the first 5 odd readings which are theory. Now the next 8 readings from 50 to 59 involves a bit of numbers, involves valuation, yield calculation. So I mean, when you are practicing on your own, you need the Texas BA2 calculator with you. Okay, right now we will be discussing concepts and a few questions, but largely this is a numerical part, and after that from reading 60 onwards again there will be theory for the last 5 or 6 readings. Okay, so that kind of takes care of the first part, where it's a much more scoring and a relatively easier theory driven part. Now going to the second, which is the more calculative and the more interesting part of bond valuation. Okay, so we'll go on into the second and probably the most interesting section of fixed income. Over here from reading number 52 up to 59, there's a lot of interesting concepts. We will try to cover every concept, do their application, their relationships, and try to discuss some numbers as well. But it is very important that you kind of apply this understanding by doing a few sums from your Schwezer or whatever notes you have to cement your understanding, at least in this specific section. So over here first you have reading number 52, which is pertaining to fixed income valuation. The value of every bond is the present value of future cash flows. The cash flows over here can be in the form of coupon as well as principal payments. So for example, if there's a bond with a $100 face value and there is a 9% coupon, 5 years is a tenure, and the discount rate is, for example, 10%. Now what is the discount rate? This is the required rate of return for similar bond investments, for similar rating, etc., and hence this is the return, that market rate of interest that the investors require. Usually the value can be found very easily by using your financial calculator, where you will input N, that is the time periods, as 5 years. Then you will have your PMT, which is like your interest which arises annually, that is, let's say 9. Then you will have the future value that you are going to get, the principal back, let's say that is 100, and the interest, the discount rate, that is, let us say I by Y, that you will put in as 10. Remember, you will not take 0.1, 10% will be kept as 10 only, and then you will compute the present value. It will come to probably a negative value, but that is like how much you will have to invest to get this bond. So this is how you will calculate the value of a particular bond, which is the present value of future cash flows. Bonds usually are semi-annual, in which case what you will take is, for a 5-year bond, if it is semi-annual in nature, there will be 10 half years, so your N will be taken as 10 years. Coupon, which is 9%, will become 4.5%, that is $100 into 4.5%, that is $4.5 in each of these time periods. There would be future value, you will get still $100, and your interest rate, which is 10%, will be 10 divided by 2, that is 5%. So basically your coupon as well as required rate will be divided by the periodicity. Let's say for half yearly, that will be divided by 2, and the time periods, that is N, will be multiplied by 2, and that is how you will find the bonds price. Further, you might even want to calculate something known as a yield to maturity. Now what do you mean by yield to maturity? This is the return that a bond will give if you purchase it at today's price. So let's say today's price is given to you. If you were to purchase it at today's price and you were to hold it till maturity. So over here, I don't know, I'm just taking up numbers. Let's say if today's price was $95, then your PV would be, let us say, a negative 95, that is your present value, and you will substitute everything else. Let's say if there was annual, the same 5 years, coupon of around $9, everything you will input except for I by Y, and that, if you compute your I by Y, that will be your return that the bond actually gives you. Yield to maturity refers to the average return, the average yield. If I were to invest in the bond today, receive all the coupons, hold the bond till maturity, then what is the IRR, or the return that I will generate from the bond? That is called as a yield to maturity, and you can calculate it very easily using your financial calculator. Now you want to identify the relationships between bonds price, coupon rate, maturity, and yield to maturity. Now the general relationship would be, one needs to remember, there is an inverse relationship between the bond's price and the market rate of interest, or yield to maturity. This is probably the most important relationship in your bond valuation. That is, as your market interest rate goes down, the bond price will go up. Well, the reason over here is your cash flows for a fixed income bond remaining the same. If your discount rate is increasing, yield to maturity will be your required rate of return expected for similar bonds. So if your discount rate is increasing, that means if the discount factor increases, the present value will fall and hence the value of the bond will fall. Vice versa, if your required rate of return reduces, but the bond is still giving you the same coupon and hence the market value will increase. So there's an inverse relationship between the bond's price and its yield to maturity. Further, if you look at the sensitivity of the bond's price with maturity. So we have discussed the relationship with bond price to yield to maturity. There is inverse relationship of the bond's price with the yield to maturity. When you look at maturity, longer bonds have much more risk because there's a lot more uncertainty, and hence longer bonds with a longer maturity will have more sensitivity to a change, and shorter duration bonds will have relatively lesser sensitivity. When you look at coupon rate, well, the more the coupon that you can collect in the earlier years, shorter will be something like the payback period of the bond, and hence lesser is the risk of the bond. Higher the coupon, lower is the risk. Lower the coupon, like in a zero coupon bond, you're not going to receive anything right till your last day, and hence lower the coupon, more is the risk. So there are a few things where you look at the relationships between the bond's price with yield. There is an inverse relationship. Like if yield goes down, up, bond price goes down, and vice versa. Maturity, more the maturity, longer the maturity, higher is the sensitivity. More the coupon, lower is the sensitivity. And we'll study this when you do duration as well. Okay, now if you actually plot, this is called as the yield curve. If you plot the bond value and the market yield, on one side you're plotting the value, one side you're plotting the yield. As you can see, as the yield goes up, the bond value will go down. As the yield goes down, the bond value goes up. However, the shape, if you actually go to see, is actually a convex shape, and later we will come to this concept of something called as convexity, which will be applied over here. Now, initially there is an important relationship you can go to see between the coupon rate and the yield to maturity. Yield to maturity is like the return that the bond generates, and as market factors changes, the market required rate can possibly change. So if there's a bond with a coupon rate of 10%, but the yield to maturity is 8%, this means people are requiring 8, but this bond is giving a 10% coupon. This bond will typically be trading at a premium over par. However, if their coupon is 10% but the yield to maturity is 12%, this is like an inferior bond. People want 12%, but the bond is capable of giving a coupon of only 10%, and hence these bonds are likely to trade at a discount. Whereas if the coupon is 10 and the yield to maturity is 10, in general these bonds will be trading at par. Now, today it is very much possible that the bond has 5 more years to maturity. It is very much possible that there is a premium bond where it's a 6% bond and the YTM is 3%. So today this bond is going to trade at a premium. However, eventually over the maturity, slowly, this bond will converge towards par. Like today its value, if you sit and calculate, maybe 1085. However, slowly, this value, ultimately, you know that if this bond is held to maturity at the end, $1,000 is going to come. So this bond will slowly gravitate, mature, or transition to par. So this is called as pull to par. Or some bond may be at a discount, like there's a 6% bond, but the YTM is 12%. So today it is at a heavy discount, let's say 852. But again, slowly, when it is going to mature, it is going to reach 1000, and hence this 852 will slowly come towards 1000. This is called as the constant yield price trajectory. So over here, as the maturity kind of keeps on reducing, your price comes and converges towards par. This is also called as a pull to par concept. So if your yield remains constant, the bond price will keep on converging towards par gradually. Okay, there's something called as matrix pricing. Now this is a concept that is used for valuing or pricing relatively infrequently traded or illiquid bonds. Over here, for a liquid bond or a frequently traded bond, you will have relevant market data. For an illiquid bond, you might not have adequate market data, and hence you might use certain techniques. You might take the on the run bonds, comparable bonds, and based on that somehow try to find the price of your illiquid bond. Like in matrix pricing, you will find the yield of your infrequently traded bonds. Like for example, you might be having on relatively non-traded 4% A plus rated bond that has 3 years remaining until maturity. Now I want to find that what should be the ideal yield that I expect on this bond. For that I look at a few other bonds. There's a 5-year, there are 2 5-year bonds which are also A plus rated. There's a 2-year bond which is also A plus rated, but there's no similar 3-year bond. So what I'll do is I'll try to do a process called as interpolation, whereby I will try to find a rate on the 5-year bond. We are saying that 5-year bond has a yield of 5.1 and 5.3. So if I take an average, that is 5.2%. A 2-year bond has a rate of 4.3. So basically I will try to interpolate between 2 years and 5 years. So it is 4.3 plus. Well, if I move 0.9%, that is from 4.3 to 5.2, then there is a change of 3 years. But I don't want to change by 3 years, I want to just change by 1 year. So that change will be how much? That is 4.3 plus the difference into 1 divided by 3, which is around 0.3% will be the change in 1 year, then 0.6 in 2 years, 0.9 in 3 years. I want to change from 2 to 3 years, and hence around 4.6%. This is, you are taking comparables and trying to price. You can even look at the spreads. That is, there may be treasury bills, there is a A-rated bond and there are treasury bills. You want to find a 6-year A-rated bond YTM. So what you will possibly do over here is, you will have treasury bills. One is 4-year, one is 6 years. Let's say if I want to find the return for, let's say a 5-year A-rated bond, then I will try to find that what will be the treasury rate for 5 years. Well, if it is for 4 years, 1.48, for 6 years it is 2.15, so 1.48 and 2.15, if I were to average it, it is around 1.85% return, maybe for a 5-year treasury bill. But my bond is not a treasury bill, it is A-rated bond, which means I will say that I will want to find the possible spread that is there on, okay, let's say a 5-year, 6-year, whatever it is. I can try to find the possible spread. So this is 1.8515%, and the difference between 2.64 and 1.815, that is 0.825%. This is the spread over treasury for a A-rated bond. Now let's say my treasury for a 6-year instrument, not a 5-year, let's say a 6-year instrument, my treasury is quoting 2.15%. However, I have a A-rated bond, and A-rated bonds are at a 0.825% additional spread, and hence that will possibly give me the yield that I expect for a 6-year A-rated bond. I have the data for a 5-year A-rated bond, I have treasury bill, so I somehow try to find the spread over the treasury bill, that is 0.825%, and then that plus the treasury rate should give me my desired value. So this kind of takes care of a broad understanding of your fixed income reading 52. Then you go to 53. Over here you are going specifically to the fixed rated bonds. In the next reading you will go specifically for the floating rate bonds. So when I look at reading number 53, you are supposed, let me just see, is there anything else that I want to discuss? No, I think that's fine. So over here, when you look at the fixed rated bond, now the periodicity will make a difference. Like for example, over here, you can sit and calculate the yield to maturity for an annual bond. However, if that same bond has a semi-annual coupon, in which case what will happen is, if you want to find the effective rate, I'm not sure whether I will have a numerical setup over here where I want to find, let us say, the effective rate, then I can do that quite easily. Let me just review this once. Do I have this handy somewhere? There's a lot of calculations. Okay, so we'll proceed on to reading number 53, which is for a few measures for fixed rate bonds. Over here, let us say if you had to look at the periodicity, like usually we look at fixed rate bonds with an annual coupon, but it is possible that the coupon can be half yearly, it can be quarterly as well. How does that affect your effective return, and how do you calculate your effective return? So if I can pull up an example, let us say there is a bond with an issue price of 9,000. Coupon is 8%, face value is 10,000, and term is 5 years. So if I want to find the yield to maturity, assuming an annual cash flow, I will take 5 years, 9,000 negative PV, 800, that is 8% of 10,000 PMT, and 10,000 face value. I will get compute the I by Y, that is 10.68%. So this is my annual yield to maturity. However, if I do the similar working for example, for a semi-annual bond. Now, when I look at a semi-annual bond, for simplicity, I might say that semi-annual bond has maybe double the periodicity, which means if there is N, which is 5 years over here, 10.5 years. If coupon is going to be 8% of 10,000, it is 800, it will now be 400, and everything else remains the same. Present value is 9,000. Future value is 10,000. If I now sit to calculate, you will get a slightly different, in fact a slightly higher, if I am not wrong, effective rate, because money is getting received faster, and hence if I go to see, you will get probably a semi-annual return of 5.31%. So this is 5.31%, which if you want to annualize, it is 5.31% into 2, this is 10.63%. Now, one can always say that 10.68% is higher than 10.63. It is because we are trying to say that what 10.63% semi-annually compounded can give is what 10.68% annually compounded will give. So basically, even with a slightly lower rate, because of the compounding effect, it is giving you a higher overall effective return. In fact, if you go to quarterly compounding, things will change. For example, 5 years will become 5 into 4, that is 20 quarters. 9,000 will be negative PV. PMT over here will possibly be 200, and 10,000 will be FV. If I do the calculation, maybe at quarterly this will come to something else. Let's say this is 2.65% into 4, this is 10.6%. So what I'm trying to achieve over here is, well, 10.68% annually compounded is the same as 10.63% semi-annually compounded is the same of 10.6% quarterly compounded, and hence this is the role of periodicity. So if you want to find the annual yield for a bond which has quarterly or which has semi-annual payouts, you will find the semi-annual yield like 5.31% or maybe a 2.65%, and then multiplied by the periodicity. That will give you, let's say, 10.6% effective annual return. Okay, now the next part over here would be to find and compare the different type of yield and yield spreads. Now over here, I think I missed that discussion. Is it? Yes, there is a discussion which was there, I think, in your earlier reading, which is pertaining to accrued interest, flat price and full price. Accrued interest would mean the interest which is accrued from the last interest payment date up to the date. Like bonds might have interest which is payable on 1st of April and 30th September. Now, if you are trying to find the value of the bond on, let us say, 1st of July, which means the last 3 months of interest has actually accrued. So your accrued interest will be calculated as, let us say, the face value into the interest into the days divided by 360 or 365 divided, depends on the convention. So that is your accrued interest. Flat price is the pure bond price. You can call this as X interest price. You can even call this as the clean price. Whereas the full price will include the accrued interest. So the flat price plus accrued interest will become the full price. Full price can be referred to as the dirty price or the total price as well. Also sometimes called as the cum interest price. So I think I had missed these points. I was wondering if it was over here, but no problem. So over here, when we are coming to calculating the yield, well, bond yields, this is just for an MCQ perspective, you don't have to worry about the workings, can be calculated using something called as the street convention or something called as the true yield. Street convention would mean that exactly when the dates are stated, let's say 30th June, then you will calculate yield taking 30th June as a base only. So that is the street convention. The rate of interest are going to paid, for example, on 1st April and 30th September, in which case you will do the calculations taking 1st April and 30th September, 1st April, 30th September, but it is possible that maybe this 30th September falls on a weekend or a public holiday, in which case interest is paid at the next day. In which case, if I take the exact actual day when the interest is going to be paid and calculate yield based on that, will be a very small difference, but that is called as the true yield. True yield will take the actual coupon date. So if there is a weekend, well, you will say that I will receive the money not on, for example, 30th September, I'll receive it by 1st October or 2nd October, you will take that as a base and do the calculation, then it is a true yield. But if you're taking 30th September and 1st April only, that is a street convention. Usually people end up doing the street convention only unless there is going to be a material difference, which is usually not the case. But nevertheless, you should be aware of these 2 points of difference. Now, when you want to calculate the yield, the most easiest way of calculating yield is a current yield. Like if you take our $100 bond, which was having a 9% coupon, $100 into 9%, that is $9, and let's say the market price was 95, then the actual cash coupon divided by bond price, that is the current price, will give you your current yield. The problem in this is it does not account for the fact that there will be capital appreciation as well in your return. So it is only taking interest, but there will be capital appreciation as well. So how will you incorporate that? Well, there is another measure called as simple yield. Under simple yield, you will take the interest, that is 9, plus you will also take the capital appreciation, that is 95 ka bond is likely to become 100. So 100 minus 95, that is 5 ka appreciation. Let's say over a period of 5 years, that means 95 and 100 ka difference, 5 divided by 5. So 9 plus 1, that will be your total. So annual cash coupon plus amortization of discount or premium as a case may be divided by the price. That will give you a simple yield. But again, this is not very popular because these are not considering time value properly. So yield to maturity is the best measure of yield. However, sometimes what happens is your bond is a callable bond. When I say a callable bond, it means a bond which can be called at the discretion of the issuer. Now it may be a 5-year bond. It may be a 5-year bond. However, it can be called back earlier. Let's say after 2 years. Let's say after 3 years. In which case, if as a holder I want to hold the bond till maturity, then I will get the yield to maturity. However, if that will be the yield I will earn if I can hold the bond for 5 years. What if the issuer calls back the bond, let's say after 2 years? Then what is the yield I will get? That is called as the yield to first call. Or what if the issuer calls back the bond after 3 years? What is the yield I will get? That is yield to, for example, second call. So you will try to find the yields considering the issuer will call at the specified call dates. There will be multiple yields, and sometimes the institute asks you to calculate the yield to worst, which means among all the yields, whichever gives as a holder the lowest yield is called as a yield to worst. Like for example, okay, there is a 5-year semi-annual 6% bond whose market price today is 102. On 1st April 24, it is callable by paying 102 on 1st January 27, that is after 3 years, or 101, that is on 1st January 28, let's say after 4 years, 24, 25, 26, yes, that's 3 years, and then 4 years, perfect. So over here, if I had to do the calculation, what I will do is, I will try to find if it is done over here, perfect. First is a yield to maturity, that is, it's 5 years, that is 5 into 2, 10 half years, n will be 10. You are going to pay 102, present value negative 102, PMT. Sorry, that is, I believe, 6% per annum, that is 3 for the half year, and ultimately FA will be 100 if you hold it till maturity, in which case your yield will be 5.537% if you were to compute your I by Y. However, if the yield to first call is happening after 3 years, which means 3 into 2, 6, after 6 half years, and 102 will be the base, which will be 5.882%. And if yield to second call, which is after 4 years, this is 8, 101, which is, let's say, the price. Similar example to what is there in your Schwezer, and this is 5.66%. So over here, what I'm trying to say is, these are 3 different yields to call or yield to maturity. If they ask you to find yield to worst, YTW, this is 5.537. This is the lowest possible yield to worst, as the case may be. Okay, so that takes care of a few of these concepts. Now, in case of a callable bond, as compared to a straight bond, what is the difference between a callable and a straight bond? Well, the callable value, like for example, if I am a holder, in general, straight bond gives me, let's say, a yield of around 6%, let us say. I will say that this bond is a normal bond, if there's a callable feature, that bond can be called back earlier, and hence I will not invest in this bond unless it gives me more than 6. Let's say it gives me 6.8%, in which case the difference between 6.8% and 6% is 0.8%, which is attributable to the callable feature. So that is kind of the value attributable to the callable feature for which a 0.8% extra spread is actually asked. So sometimes they can ask you to calculate something called as option adjusted yield. What do you mean by option adjusted yield? Option adjusted means if you were to remove the effect of the option, then what will be the yield? Like your bond is a callable bond, you do your calculation under the callable bond, you get a 6.8% yield because all the data is there for the actual bond, which is a callable bond, you get 6.8%. You will take a similar non-callable bond and try to find the yield, in which case that comes to let's say 6%, in which case 0.8% is a value attributable to the call feature, or you might be given the fair value of the call feature, which is around 0.8, in which is 6.8 minus 0.8, that is 6, would be the value for your option adjusted or the straight bond. So over here, what you need to also review, I think it is there in this particular topic, or it is there in, yes, there is something called as a yield spread. Now this is quite important. I would say yield spread can be the difference between your actual YTM and some benchmark. Now what can that benchmark be? That benchmark can possibly be, let us say, the government bond rate. Like your bond has a yield of 15%. Your comparable government bond has a yield of 12%. Then 15 minus 12, that is 3%, is called as your G spread. G spread is a spread between your bond and a comparable government bond. So benchmark spread is the difference of your bond with the YTM of a benchmark security. If your benchmark security is a government bond, that is G spread is calculated as YTM of your bond minus the YTM of a government bond or comparable on the run government bond. Some people say that instead of taking the government bond, we will take the rates of the interest rate swaps which are running, like SOFR, the secured overnight financing rate. We will take some, rather than taking the government bond rate, we will take, let us say, the prevailing interest rate in the interest rate swap market. So this is called as, for example, I spread, where let us say 15% is your bond rate, there is 13% which is the rate on a comparable interest rate swap in the overnight or in the interbank market, in which case 15 minus 13, that is 2%, is your I spread. So this is taking the difference against a benchmark being a government security or an interest rate swap. Then you have a couple of other very interesting spreads called as zero volatility or Z spread and option adjusted spread. Now when you look at the Z spread, for which you need to understand the concept of spot rates, which we will discuss in some times, what happens is yield to maturity is like your average rate. Like for example, if there is let's say if there is your regular graduation or your CA exams, where you have 3 papers, paper 1, paper 2, paper 3. In one paper you score, or let's say there are 4 papers. In one paper you score 80, in another paper you score also 80, in the other 2 papers you score only 40 and 40. If you take your average score, that 80, 80, 40, 40, average score will come to around 60. So the general understanding will be, on an average you're scoring 60 in every subject. However, that is not actually the case. You're actually scoring 80 in one of the subjects, maybe you're scoring 40 in another subject. So it is the same case in case of, let us say, a bond. A bond has a 5-year maturity. There is a cash flow in the first year, cash flow in the second year, cash flow in the third, fourth and fifth year. Let's say it's a $100 bond which will give you $9, that is 9%, $9 cash flow in the first year, another $9 in the second year. We are trying to say that if this was a zero coupon bond only for 1 year, which is maturing and giving me $9, then how much will be the rate that I expect for the 1 year zero coupon bond? Maybe that's a different rate. If there was another zero coupon bond which is maturing after 2 years and giving you $9, then what is the rate that was expected over the 2-year period? You try and find that is going to be the spot rate for 2 years, similarly for 3 years, similarly for 4 years, similarly for 5 years, and this is the most accurate way in which you can do bond pricing. YTM is generally an approximate way. The most accurate way is you try to infer, derive, calculate the spot rates. How will you calculate the spot rates? Treat every cash flow of the bond as if it is a separate zero coupon bond and try to find that what will be the return for just the 1 year's cash flow, just for the 2 years cash flow, just for the 3 years cash flow. That should ideally be discounted by the spot rate of that respective year. And as a result, over here, you try to find the spot rates. Now, the problem is YTM assumes, in a way, if I were to take the example of marks, it assumes that every 4 papers, or there are 4 years, there are equal marks in each of the papers. Like if the YTM comes to, for example, let's say, I don't know, 10%. It assumes the required rate of return is 10% in the first year, 10% in the second year, 10% third, 10% fourth. That is not necessary. It is possible in the first year, you are okay getting 8% return. Second year, you want, for example, 10% return. Third year, you want something 12% return or something like that. And hence, on an average, it is stacking up to, let us say, 10%. That is not necessarily the case. So, spot rates will actually find your actual rates, assuming every cash flow was a separate zero coupon bond, then what is the rate for that cash flow, and that will make you a curve called as the spot yield curve, a very important curve in practice. A spot yield curve where you are looking at the spot rates for each of the maturity, for 1 year, 2 year, 3 year, 4 year. You don't want as a 5-year maturity, but to say that in each of the 5 years the average return expected is the same is also not always correct. So you try to find the actual spot rate expected in each of the years, and fundamentally the weighted average of these spot rates where cash flows are taken as weights should give you, the average should give you the yield to maturity. Like the average of all the marks gave you your average marks. In a similar way, the average of all your maturity, all your spot rates, which is weighted, where the weight is, let us say, the cash flow, will give you the final yield to maturity, but spot rate individually is very accurate. So when I look at the Z spread, what I do is I take the actual spot rates for each of the year, and I say that the value of the bond, I don't know if I have a numerical over here because that is always better to understand with the numerical, but if I were to take, for example, just a second, do I have this? I don't think so. Maybe it might be there. Okay, there you are. So over here, let's say there is a bond where today the price is 89.464. Value of a bond is the present value of all the future cash flows. So if I find the actual cash flows, it's 9%, so 9, 9 and 109. Now the spot rate in the first year is 4%. For the second year, it is 8.17%. Let's say you were told that these are the treasury bill or government bond rates for year 1, for year 2, for year 3. So I'll say that the value, my bond is not a government bond. So my bond will have a return which is greater than the government bond. However, the government bond rates for the 1 year is not the same as the second year, third year. So these spot rates are different. So I will say the value of a bond is the present value of all the future cash flows. But while doing the present value, I will try to find, I will take the spot government bond rate. Actually, you can even take the spot your bonds rate, which maybe you don't have, but let's say you have the government bond rate plus Z. Z is that spread. If I do the working using trial and error, I'll get around 1.67%, which is your Z spread. What does the Z spread mean, and how is it different from a G spread? In case of a G spread, what did you do? You took the average. In case of G spread, please pay attention, in case of G spread, you took YTM, that is the average rate of government bonds. Here, government bonds had different spot rates. I'm saying forget that. Let's say, I mean, you were given the YTM over here to be around 8%. And you will compare this with the YTM of your corporate bond, which comes to, let us say, 12%, or 10%. In which case, your G spread will directly take the average difference, that is 2%. However, when you look at the Z spread, in case of Z spread, it happens that government bond in year 1 is fetching 4, in the second year is fetching 8 point something, in the third year is fetching 12 point something, which means if I were to find the spread between each of these spot rates and your bonds rate, like 1.67 is the case, which means if 4% is a government bond, then 4 plus 1.67 will be your bonds 1 year required rate. Second year में 8.167 plus 1.67 will be your bond second year spot rate, and third 12.37 plus 1.67 will be your bonds 3-year spot rate. So this is a difference. Z spread is a difference against the spot rate curve, whereas the G spread is the difference against directly the YTM yield curve. Okay, a little complex. And lastly, you have this option adjusted spread. When you look at an option adjusted spread, that is just the difference between let me just show that on your screen right now. Okay, Z spread is a spread based on spot rates, that is spot bond rate and the spot government bond rate, like we just discussed. And option adjusted spread is for bonds with embedded options, like there can be a callable option or there can be a puttable option. We'll again discuss that, but a callable option is an option where the issuer has an option to call the bond back. In a puttable bond, the holder has the option to put the bond back. So over here, this will be the Z spread of your actual bond. Yeah, but my bond is callable. So from I am expecting, for example, Z spread of a particular 1.67%, for example. However, maybe 0.8% is attributable to the callable feature. So if I remove that callable feature minus that will give me the option adjusted OAS, option adjusted spread. Sir, iske pehle bhi it's very confusing. I agree. You'll have to remember these concepts. There's no other way, unfortunately. Option adjusted yield, what it does is it takes the YTM of the entire bond and compares the YTM of your actual callable bond with the YTM of a straight bond. However, yahan pe I want to look at against the spot rates, in which case I take the Z spread considering the spot rates, and from that I will deduct the option value, call value, for example. So over here, if I have a number set up for that, let's say there is a straight bond which is, and then there is a callable bond. You do all of this working, its YTM is 10.68%. For a callable bond, the YTM is 12.18%. This is your option adjusted spread. 1.5%. The difference is your option adjusted spread. Value of call feature is the difference between 9,000 and 8,500. That is the value of the call feature. So if I look at the callable bond, this is just the value. 8,500 is the value of the callable bond. 500 is the value of the call feature, which means if I were to look at the value option adjusted means straight. Had there been no options, then this bond would be worth what? 9,000. This is applicable for rupees. If you're doing it in percentage, it will be a spread. If this is done in rupees, it is an option adjusted value. So when I'm looking at, for example, option adjusted spread, that is the Z spread minus the option value, let's say for a callable bond. Now there can be possible changes in yield, and if there's a change in yield, that change, like your bond, will be affected by two things. One is macroeconomic factors, and that is factors for the economy. Like if the inflation goes up, government bond rate goes up, the yield on your bond will also go up. Now that is due to a macroeconomic factor. If the government bond spread changes and your bond also changes in tandem, then that is due to macroeconomic factors. Or it can be microeconomic factors, like the government bond, there is no change, but your bond's yield change. That is not because of inflation or a macroeconomic factor, that is because of your microeconomic factor, like there may be an increase in credit risk or some default risk that is happening. Then it is possible that your spread will widen. Like if I just throw up an example over here, let's say you have a 5-year AA rated bond and a 5-year government security. Today 7% is the rate of your bond and 5% is the rate of GSEC, which means 2% is your G spread. Now in response to certain changes, your government bond rate changes from 5 to 6. So there is an increase in 1% in the government bond, and your bond also changes in tandem from 7 to 8. So this is, your G spread remains a constant. So this change is due to macroeconomic factors, macro. However, let us say the government bond remains the same. From 5%, it remains the same at 5% only. But your bond from 7 moves to 8. Now that is not because of inflation or a macroeconomic factor changes. Maybe that is because of certain change in your bond's performance. In which case, how will you detect that the change is due to macro or micro factors? Well, your G spread will change. Now if the change was due to a macro factor, then the government bond rate changed, your bond also changed in tandem, your G spread remained the same at 2%. However, if let's say it is due to a micro factor, then your bond's rate changes, government bond rate remains the same, so your G spread widens in this case, or it can even narrow. Now that is due to, for example, certain microeconomic factors. So I guess this kind of takes care fairly well of these concepts, and we'll move on into the next reading, which is on floating rate instruments. Okay, so when we look at the floating rate instruments over here, in case of floating rate instruments, the rate is usually quoted as a market reference rate plus a particular margin. So market rate reference rate can be something like a SOFR, or in UK something like a Sonia. These are overnight financing rates. Like earlier it was LIBOR. So over here you can have these market reference rates, plus there would be certain spread. Why? Because your bond is not exactly equal to, let's say, an overnight interbank bond, and hence there will be certain margin like SOFR plus 2%. So that 2% is the quoted margin. Now in case of floating rate instruments, what happens is at every reset period, the coupons are reset to take them back to the prevailing market rate, and hence what usually happens is the value of a bond is very close to the par value only. In a fixed rate bond, what happens? Coupon rate is 10, market rate is 10, great. But then market rate moves to 12, coupon is still 10, and hence the bond price adjusts, or the market rate moves down to 8, coupon is still 10, and hence there is an adjustment in bond price. However, over here there may be no adjustment in bond price, and as a result we can say that in this particular scenario your bond value will be very close to the par value. However, why will there be a difference? Well, because it is possible that as market reference rate changes, the bond's coupon is changing in a floating rate bond. However, the quoted margin of 2% remains the same. What happens if your bond's credit risk increases, for example? You are in very much difficulty. Now, in which case also the rate continues to be market reference rate plus 2%. However, people will now say, no, we are not going to be okay taking just 2% extra, we want more. However, on your bond, you are paying market reference rate plus 2% only, but the required margin or the discount margin, as they call it, quoted margin is the margin quoted on the floating rate instrument, and the required margin is the margin which investors are requiring. Let's say the required margin becomes 3%, which means your coupon is going to be market reference rate plus 2%. As market rate reference rate changes, your coupon will also change. However, your quoted margin of 2% remains the same. And hence, if there's a $100 bond and the market reference rate is, let's say, 5%, 5 plus 2, 7% will be your coupon. But people are now expecting, due to the higher credit risk, people are expecting, let's say, 5 plus 3, that is 8%. And hence, in such a case, if your required margin is greater than the quoted margin, people require now, in light of the changed circumstances, people require 3%, you are giving only 2%, in which case this bond will go at a discount. On the other hand, if you had initially quoted 2%, but then scenarios improved, now people are much happy, your credit rating improved, people are happy even at 1%, but you are still going to pay 2%, in which case your bond is going to pay 5 plus 2, that is 7. When people are happy at even 5 plus 1, that is equal to 6, and hence in such a case your bond will go at a premium. So the important thing that you remember in case of a floating rate bond is that prices are going to be more stable than that of a fixed rate bond. Coupons are reset periodically based on the market reference rate at the start of the respective reset period, and there is a quoted margin and a discount margin. Quoted margin is a fixed margin which is quoted above the MRR initially on the bond indenture, and discount margin is required based on the prevailing scenario. Initially, the floating rate instrument will be at par because usually the quoted margin will be equal to the discount margin, but subsequently, if the quoted margin continues to be equal, 2%, people require 2, the bond will continue to remain at par. But if the quoted margin is 2% and the required margin is 3%, the bond will go at a discount. If the quoted margin is, let us say, 2% and the discount margin is 1%, then the bond will be at a premium. On a simplified way, if you want to find the value of a floating rate bond, you can calculate it as a present value of the future cash flows as the market reference rate plus the quoted margin, and the discount rate will be the market reference rate plus the discount margin, and that will help you finding the bond value for a floating rate bond. Further, over here there would be certain workings regarding money market instruments. When you look at money market yields, money market is short-term market like treasury bills, commercial paper, certificate of deposit, all of these. There are two ways in which yields over here can be quoted. One, there can be something called as an add-on yield, and second, there is something called as a discount yield. What do you mean by add-on yield? It is like 100 over and above 100 if the yield is 2%, over and above 100, 2%, that is 2 will be paid. Okay, that is add-on yield. Second is discount yield, where like a zero coupon bond, rather than giving the bond at 100, paying 2 separately, I will say I will approximately give you the bond at 98. and then on that pay you 2. So the yield is 2 on, let us say, 98 for example. So that is like a discount yield. Now certain money market instruments are given on an add-on basis, that is your bond plus the interest will be paid. Certain are given on a discount basis, like commercial paper or treasury bill is usually on a discount basis, whereas a bank certificate of deposit, like a fixed deposit that you invest in a bank, for example, is on an add-on basis even if it is short term. So over here, these are the two types of yields which can be calculated. You can find the yield for the holding period as, for example, if it is a discount yield, you can always say that this is $2 of yield on $98 of investment. So $2 of yield upon $98 of investment. So that is around, let's say 2.04%, but that is for the holding period. I want to find it on a per annum basis. So I will have to annualize it like into 360. Into 360 or 365 depending on the convention you are using, divided by the actual days. So let us say this was for 91 days. This was for 91 days. I am saying that this treasury bill is a 91-day treasury bill, and it is giving me a yield of $2 on an investment of 98. So your holding period return will be 2.04%, but this is 2.04% for example 91 days. I want to find it for total. So this is 361 divided by 91 as a case maybe, will give you into whatever 365 divided by 91 comes to, let's say, 8.18% or something. So this will be one possibility, but the problem over here is there are two conventions in money market. One, there can be something called as actual by actual convention, which is usually used in bank certificate of deposits, etc., or there can be 30 by 360 convention, which is usually used in treasury bills or commercial paper, etc. So if it is 30 by 360, which means I would say that my bond is a 3-month bond, that is 3 months is 90 days, and in a year there are 360 days. But if it is actual by 360, actual by actual convention, then you will take actual days, that is 365 in a year, and 91 days as a case may be. So usually your add-on yields are based on actual by actual convention, whereas your discount yields are based on 360 by 30 convention. But this is what is given to you in your notes. Again, this is not a law or a rule. Every instrument they can mention what is the convention to be followed, and accordingly you can take. So add-on yields are annualized interest rate on the amount deposited today. So $100 ke upar, what is you are going to get add-on, like this is common in bank certificate of deposit, even repo on the loan it is added, usually based on 365 days convention. Quoted yield will be holding period yield, like 2.04% for example, into 365 by days to maturity. On the other hand, on discount yield, this is also annualized current discount. So discount is $2 from the face value. This is common for treasury bills, commercial paper. This is based on 30 by 360 convention, which means your quoted discount yield will be actual discount, that is 2.04% into 360 by, for example, 90, and that will give you the money market yields. Okay, so that takes care of, I believe, your reading number 54 as well for floating rate. Next, you will try to go into the term structure of interest rates, spot, par and forward curves. So over here, the first part over here pertains to spot rate. We have discussed spot rate at some level of detail in the earlier reading, I guess. What are spot rates and what is yield to maturity? At the cost of repetition, yield to maturity is an average rate over the entire tenure that you are earning, like the IRR, the average rate of return. However, spot rate will treat every cash flow as if it is a separate zero coupon bond and find the actual rate during that particular for that particular tenure. So for 1 year, maybe there's a separate, let's say there is a 3-year 5% bond. Spot rate for the first year, rates prevailing for 1 year similar government bonds is, let's say, 3%. Spot rate for the second year is 5%. Spot rate for the third year is 5%, in which case the value of this bond in a way will be calculated as it's a 3-year 5% bond. Let's say $100 is the face value, 5 for the first year divided by 1.03 plus 5 of the second year, but this is 1.04 raised to 2 plus 105 of the third year divided by 1.05 raised to 3, and that will give you the value of your bond considering the actual, and this is sometimes called as a no arbitrage price, because if the price is different from this price, then there is a possibility or a scope for arbitrage. The most accurate measurement of price is calculated using this. Now, this is regarding spot rate. Two other types of rates are called as par rates, and then there is forward rates. So when you look at par rate, what happens is, in case of a par rate, there will be a hypothetical bond. It's not an actual bond, it's a hypothetical bond, and on that hypothetical bond, what will be the actual coupon that will be there for ensuring that today's price is met. So there will be different spot rates like 3%, 4%, 5%, for example. So over here, when you look at a par bond, par yield is a coupon rate that a hypothetical bond will earn at each maturity, same, to be priced at par. Now, I don't know what the price of the bond is. Whatever is the price of the bond, you will take that. For example, the price of the bond is 95. Okay. For example, you'll have to do this using trial and error method. Okay. In which case, the first year's rate is, let's say, 0.03 spot rate. So this is 1.03 squared, 1.03 raised to 1, which is, let's say, x plus x upon 1.04 raised to 2 plus, let's say, 100 plus x upon 1.05 raised to 3. Now, the only missing variable over here is x. So you will sit and solve and you will get the answer. I'll again see if I can show you a numerical which we might have done, so it is easier for you to understand. Yes. So this is, let us say, a hypothetical bond. For this bond, let us say 100 rupees is the value today. Let us say par value today. It can be, par value can be 100, it can be 95, it can be anything. Like, for example, it is 100. So I'm trying to say that at what value, at what coupon will the bond have a par value at the respective spot rates. So for a hypothetical bond which has a par value of 100, 3%, 4%, 5%, let's say PMT is X, you take these workings and you find 4.93%. So this is called as your par yield. Okay. And par yield is not as important, I would say, from an exam perspective or from a practical life perspective as your spot rate or forward rate is. So what is a forward rate? Now things are getting very messy. Forward rate means if I want to borrow for 1 year after 1 year, I'll again repeat. If I want to borrow for 1 year after 1 year, sir, that is spot rate. No, spot rate, if it is 3% for the first year, that means if there is a zero coupon bond for an investment for 1 year, it will give me 3%. If the spot rate is 4% for 2 years, which means if it's a zero coupon bond of 2 years, the return is 4% per annum for each of the years. If it's 5% for 3 years, zero coupon bond for 5 years, it is the rate of 5% in each of the years for 5 years. That is spot rate. But when I look at, for example, forward rate, what does forward rate mean? I'll just try to take the luxury of doing it here only. So forward rate means if I want to borrow after 1 year for a period of 1 year. Now how will I do that? Well, that is based on the principle that $1 after 2 years will fetch the same return whether it is invested at the spot rate directly for 2 years or it is invested at spot rate for 1 year and then rolled over at the forward rate for the next year. Little difficult to understand, but if I were to take, let's say, spot rate for 2 years is 4%, so 1.04% for $1 today will be 1.04 raised to 2 after 2 years equals, let's say, 1.03. This is, so $1 today after 1 year will be 1.03 plus 1 plus R2. This is called slightly differently, but let us say this is 1.04 into equal to, this is 1.08. 16 equals 1.03 into 1 plus R2, and hence this will come to, let us say, what? 1.0501 is 1 plus R3, which means if I were to borrow for 1 year after 1 year, this is usually quoted something like this, 1y, 1y. That is, if I were to borrow rate, if I were to borrow for 1 year after 1 year, then what will be the rate? It will be 5.01%. This same analogy can be drawn into the third year as well. Like in the third year, for example, your rate was 1.05 raised to 3. So 5% for 3 years spot rate will be, let's say, you can always take for 2 years, the rate is 4% into 1 plus R3 and you solve this. Acha, this R3 can be called as 2y, 1y. What does this mean? That if I were 2y represents the time period after which you intend to borrow, so that is after 2 years, and 1 year represents the length. So if you were to borrow after 2 years for a period of 1 year, then what will be the rate? So this is 2y, 1y for example. So over here, when you look at forward rates, if I see over here, do I have? Yes, forward rate is borrowing or lending for a loan at a future date. So for, let's say, borrowing for 1 year for n periods, there's an example over here. If there's 1 year spot rate is 2%, 1 year forward rate 1 year from today is 3%, and 1 year forward rate 2 years from today is 4%. Then what is the 3 year spot rate? Well, this is the other way around. We'll say 1 plus S3. I don't know the spot rate, raised to 3 equals to 1.02 into 1.03 into 1.04. If I do this working and I will solve, I will ultimately get my S3. Okay, so that comes to around, I'm not sure, 2.997%, let us say. Okay, similar, you can work backwards. You will take another example. Let's say if S1 is 4%, forward rate 1 year from now is 5%, 2 years time is 6%. Okay, so you can even use all of these workings. I mean, these are just different examples to find the value. So you can take 4% value of a bond if you have to find present value of future cash flows. Future cash flows over here can be taken as, for the first year this is 4%, second year 4% for the first year, 5% for the second year, third year 4% for the first year, 5% for the second year, 6% for the third year. Value of a bond is the present value of future cash flows, and here you are doing valuation. So there are 3 different ways. Full confusion, full chaos. Okay, you can do valuation using YTM. In YTM, it is the same rate in each of the years. In spot rate, you will take the respective rate for the respective cash flow, and in case of forward rate, you will take, for example, the respective rate for the respective year. So for the first year 4%, I'm sorry, for the second year 4 and 5%, for the third year you will take 6%, but then for the second year 5, first year 4. A bit of practice is a must for you to understand this better. Now if I were to plot as curves, there are 4 curves which are possible. On one side you will have, let us say, maturity, that is the time periods, and on the other side you can possibly have the YTMs, in which case that entire curve is called as the yield curve. Yield curve will be taking YTM of similar active bonds, or you can have the spot curve where you will take the spot rates for the respective maturities. Or, so in a YTM, you will say for 3-year bonds, what is the YTM, for example. For 5 years bond, what is the YTM? In spot rate, for each of the maturity, you will try to find what is the spot rate. In a par bond, you will put yields of par bonds. This hypothetical bond that you calculated is the least important. And in a forward yield curve, you will put yields for 1-year security for each year into the future. So over here, these are the 4 types of curves. In one of the curves, you will take the YTMs. In one of them, you will take the spot rate. In one of them, the par rate, and in one of them, the forward rate. Now, usually from an exam perspective, if you have to come on an MCQ, you will remember that the flattest of these will be the par rate. It is the most smoothened, followed by the spot rate, and the future is the most steepest. It is taking the incremental impact for each of the changes. So if it is an increasing interest rate environment, the par rate curve will be the kind of having the least slope, followed by the spot rate curve will be relatively more steeper, and the forward rate curve will be steepest. But it is falling the same. The fall of the par rate curve will be relatively the most smoother, followed by spot rate, and forward rate will have, I mean, if I just look at the numbers also over here, you look at the spot rates. The spot rate over here for 2 year was 4%. Forward much higher, 5%. So the jump in forward rate is much more steeper, and hence forward rate curve is much more a steeper curve. So this is from an exam revision perspective, at least there is deeper understanding, but you can restrict over your understanding from an MCQ perspective if it comes. So this is quite helpful. Okay, so I believe this kind of takes care of a broad understanding of the spot rate, forward rate, as well as your par rates, slightly different workings. So there are quite a few numericals I think we had done, but that's fine. Next you will go into the term interest rate risk and return. So over here we will try to understand 5 very important relationships in your Schweser. There are actual numericals documenting those relationships. I'll just try to focus on the conceptual understanding, and this may be helping you form the base for concepts like duration, etc. So over here, if you just focus on the screen, so over here there are some important conclusions that are being drawn up into how the bond price will be impacted by a possible change in YTM, or what if the interest rate remains constant, you hold the bond till maturity, you sell it before maturity, or the interest rate changes, you hold it till maturity, you sell it before maturity. So a lot of deep concepts, okay, so just sit back and hold tight. Now the thing over here is, in bonds there are two risks. Eventually, when I will put in my money in the bond today, let us say I invest a particular amount today, and this bond is going to give me cash flows in the form of coupon, and on maturity will give me my principal back. That is typically the case. Now I will invest today and I will expect to earn the prevailing rate of interest. So if I buy the bond today and hold it till maturity, then I will earn the prevailing rate of interest. Now, but is it possible that the market rate of interest will change? Well, yes, it is very much possible that the market rate of interest can possibly change. But we will say, how does it matter? Let the market rate of interest change. I have invested in the bond, perfect. But there are 2 facets that you have to look. First, the reinvestment, that is the coupon that you will receive. We'll stick to our same example of a $100 bond with 9% coupon for 5 years, in which is a $9 that you will get. You will have to reinvest it. $9 you will get, again you will reinvest it. $9 you will get, again you will reinvest it. When you are doing this reinvestment, you will earn some return. Now, generally, bond theory assumes that whatever is the rate today will remain in the future, it will continue, and as a result, if today you are earning a yield of 10%, for example, when I receive the coupon, I will also reinvest it somewhere to earn the same 10% only. So that is the first risk, that is a reinvestment risk. That is what might happen if you were to purchase the bond today, you want to hold it till maturity, however, the interest rate changes. Now, if the interest rate changes from 10% to let us say 5%, then whatever coupons you will receive will have to be reinvested only at 5%, and hence that will result in a reduction in your overall yield. Or you invested today and the market rate of interest changed, it increased to 15%, and whatever coupons or cash flows you are getting, you will reinvest at 15%, and thereby it will push up your income a little more. So if the rate remains 10% only, then there is no change. So if you purchase the bond, listen to this, if you purchase the bond today, the interest rates remain unchanged and you hold the bond till maturity, then your YTM is locked. There will be no change. That is the first thing. That is, if you were to hold the bond till maturity, there's no change in YTM, then your actual return will be the same as YTM at the point of your purchase. This is logical. Second is it possible that I can sell the bond before maturity? Well, yes. But when you sell the bond before maturity, there is something called as a price risk. That is, the bond's price will possibly change. Now, when you invest in the bond today, the value of a bond is the present value of future cash flows. That is based on today's rate of interest. However, after 2 years, if you were to sell the bond, then the value will be, let's say it's a 5-year bond, 2 years are gone by, 3 years are remaining. The value of that bond will be the present value of the remaining 3 years of cash flows discounted at the then prevailing rate. The concept over here is if the then prevailing rate is still the same. So, if today the rate was 10%, 2 years later also the rate is 10% only, then there are mathematical calculations that you can show to prove. But from an exam perspective, you can remember that if your yield to maturity, which was there originally, that rate remains unchanged, then even if I sell the bond before maturity, the price would have changed in such a way that you are still going to make the same return. There will be no change. If the bond is sold before maturity, the YTM is unchanged, then the return is still equal to the YTM only. That is point number 2. Now comes the slightly more interesting part. So what have we studied? Well, if the YTM remains unchanged, the moral of the story is, if the YTM remains unchanged, then whether you hold the bond till maturity or you sell it before maturity, theoretically you will get the same return. In the first case, we will say that there is a reinvestment risk, but there's no problem. Your return is 10%, you are reinvesting and earning also 10% only, so there's no problem in that. Point number 1. Point number 2, well, there is a price risk, because along with reinvestment risk, there's a price risk as well, but because the discounting factor still remains the same, the prices would have changed in such a way, you can sit and do the calculation that your yield to maturity remains the same. There are enough workings that we have also done, and it is also there in your Schwezer. You can refer that, but long story short, you can remember that if the bond is either held to maturity or sold before maturity, if the YTM remains unchanged in the market, then your return will also remain unchanged. But what if the YTM changes? Very much possible that YTM changes. Like in the third case, you intend to hold the bond till maturity, but the YTM changes. That is, conceptually the YTM increases. You are holding the bond till maturity, so there is no price risk. You are not going to sell the bond, so I am not worried about the price. But the coupons that I get, I will have to reinvest, and as a result, I am worried about the reinvestment risk. So over here, if I am holding the bond till maturity, I had invested when the YTM was 10%, now the YTM is 15%. In such a case, I will reinvest the coupons at a higher rate and fetch 15%, and hence, at a higher YTM, my actual return will also be higher. So over here, there will be higher YTM, my actual return will also be higher because the reinvestment will fetch me a higher final outcome. But at a lower YTM, well, my reinvestment will happen at a lower rate, and hence, my overall return will be lower than my originally prescribed YTM. This is also intuitive. People kind of do make sense over here. Now the problem is the fourth case. Now fourth case is very interesting. When you look at the fourth case, there's a lot of possibilities. Here, see, in one of the cases, so there are 4 possibilities. You are holding till maturity or selling before maturity, or YTM is same, YTM is changing. So over here, you are selling before maturity and YTM is also changing. So there are a lot of moving parts. Now, if you are selling before maturity, please pay attention, uninterrupted attention now. If you are selling before maturity, let's say it's a 5-year bond, you are selling it in 1 year only. If you are selling the bond in 1 year, that is in a very short duration, then you are really bearing the price risk. You are not really bearing the reinvestment risk, because you are hardly having opportunities to reinvest. You are exiting the bond in, let us say, a year's time. So, kya reinvestment is going to happen? Okay, so you are really bearing the price risk. However, if you are holding the bond for a very long period, let's say 4 years, 4.5, 5 years, then you are hardly bearing any price risk, because of the convergence to par. You are ultimately going to go to the par value only. The real risk you are bearing is the reinvestment risk, the coupon of the first year being reinvested, coupon of the second year being reinvested, and so on. So simplistically speaking, in a short term bond, the real risk you are bearing is the price risk, that is interest rate changes. We have studied earlier that if interest rate changes, bond prices changes inversely. That is, if interest rate goes up, the YTM goes up, bond price will go down. Someone will say, no, YTM will go up, bond price is going down, but there is reinvestment which will happen you are selling it very quickly. There is hardly any reinvestment gain because you are selling it very quickly. So if you are selling before maturity, I don't know when, it can be selling very quickly or selling let's say quite later, but you are selling before maturity and there is a change in YTM. Now that means YTM can go up, YTM can go down. So if I'm selling before maturity, let's say very quickly in the short period, and the YTM has gone up, that means my price has fallen. So my return is lower, but that is not compensated by a gain on reinvestment. And hence, for shorter tenure exits, if I sell before maturity in a shorter tenure and YTM has gone up, my return will fall. So over here, that is what I'm saying. If there is a higher YTM, and all this chart, if there is a shorter investment horizon, then your price risk will be greater than the reinvestment risk and you will fetch a lower return. You'll have to again understand, let's say you understand it from the perspective of a longer bond. Now, if you hold for a very long period, then ideally market price is going up, if market rates are going up, bond price should fall. But if out of the 5-year bond you are holding till 4.5 or almost 5 years, in which case the remaining maturity is hardly anything. There's convergence to par, so there will be not much change in the price, but the reinvestment will be important. And now reinvestment is happening at a higher rate. And if reinvestment is happening at a higher rate, reinvestment gains will over kind of power the price fall. And hence, if there is a higher YTM and if you're holding for a very long period, that is going to give you a higher return. So as you can see, reinvestment return is better than price risk, you will get higher return. Vice versa, if YTM reduces, YTM reduces, bond price will increase. And if it's a shorter duration bond, well, bond price will increase, but reinvestment will be lower. But if you're exiting in the shorter duration, then what will happen is the price gain will overpower the reinvestment loss because you're hardly reinvesting anything. So over here, for a lower YTM, in a shorter investment horizon, best. It will increase your return. Price return is greater than the reinvestment risk, you will get a higher return. And last, is at a lower YTM for longer duration bond, well, the bond price increase will be hardly anything, but reinvestment pay you are getting a lower income, and hence this will result in a return which is lower. So this entire page or chart is quite interesting and complicated. There are a lot of numerical proofs that even in your Schwezer notes are given for this particular concept, but if you kind of understand the essence of this, I would say that is sufficient. So there is a lot of literature pertaining to this particular point. For investment horizon, as a summary, we will say if your investment horizon is short term, then price risk is your real risk. Reinvestment is not really a big factor. But if your investment horizon is long term, then you are going to reinvest your coupons, and reinvestment is a bigger play as compared to the market price risk. Okay. So over here, that is the first part, a lot of literature on that. Describe the relationships upon the bond's holding period, its Macquare's duration and the investment horizon. Now before that, we need to calculate and understand what is meant by Macquare's duration. Macquare's duration is the time-based weighted average of the time to maturity. Like for example, if I were to review, I'm not sure if there is a numerical that we can see over here. Yes. So I would want you to see the duration. Okay, so over here, let us say there is a 5-year 11% coupon bond, price is 86.59 and yield to maturity is 15%. Now over here, if I had to calculate the duration, I would say that what is the tenure, year 1, 2, 3, 4 and 5, what is the cash inflows? Well, 11% of, let's say 100, that means 11, 11, 11, 11 and last mein 111. Okay, this will be discounted at the rate of 15% and you will try to find the present value factor. So the present value of each year's cash flows will be calculated and this total will be the present value of all cash flows, 86.59. Now I will try to find the weights. Like for example, if this was, let's say 1 divided by 15%, I mean, I'm just doing it in a traditional way. Let us say this is 0.8696, 11 into 0.8696 will come to 9.56 and 9.56 divided by 86.59. So I'm saying over here 9.56 divided by 86.59, approximately 11.5 or 0.5% of the cash flows are recovered in the first year. Then how much percentage of the cash flows recovered in the second year? How much percentage of the cash flows recovered in the third year? Basically, I'm doing a time-based weighted average. I'm receiving the cash flows, 86.59 that I'm investing over 5 years. If someone came and walked out to me and said, if instead of paying this money over 5 different years, if I had to pay this money on a single date, average due date, when would that be? So I will try to find the time-based weighted average similar to a discounted payback period, and that is your Macquare's duration. So over here, if I have this working over here, as you can see, time 1, 2, 3, 4, 5, 11 discounting factors are there, and I'm trying to find the weights. I'm saying out of 86.59, 11% recovered in the first year, 9% in the second year, 8% in the third year, 7% in the fourth year, and 63% in the fifth year. So if someone comes and says that if instead of paying these different amounts at different dates, if I were to pay you a single amount at a single date, when will I pay this? Well, I will try to find the time-based weighted average, and that will come to around 4.0 0.03. This is called as the Machiavelli's duration. A very important number. Statistically, if I were to calculate it, it is just the time-based weighted average, where each year that you are receiving is the base, and the present value of cash flows that you are receiving at that point is, let us say, the weight. And if you take the weighted average, it will give you like the discounted payback period, or like the average due date. That if instead of paying different amounts at different dates, if I were to pay a single amount at a single date, what date would that be? That is the Machiavelli's duration, and this is how you will typically calculate it. However, if you want to understand the significance of this, this is that time duration which is the ideal time duration. See, what was happening initially was we were saying that at certain time periods, like if I were to sell it very quickly, if the market rate of interest has gone up, my bond price will go down. But if I sell it very quickly, I will suffer a loss, because my reinvestment benefit will not overpower the price loss. Or let us say if the market interest rate has fallen, bond price will go up. But if I hold it for way too long a period, then my reinvestment will happen at lower rates. My price might increase marginally, but my reinvestment loss will be greater than the price gain. So there has to be that ideal optimum time period where the price risk and reinvestment risk cancel out, negate each other, and that is measured by duration effectively. And there is a proof which is there in your Schwezer as well. For example, if this was a bond, and in this bond your duration is actually 4 years. Now if your investment horizon is also exactly 4 years, which is same as the Machiavelli's duration, it is investment horizon is also 4 years, and if you sit and find the return, if I were to exit the bond, if the YTM becomes 4% or YTM becomes 16%, you can see this example which is there in your Schwezer. We are saying that let's say my investment horizon is 4 years, Machiavelli's duration is also 4 years. So is 4 years way too long? No. Is 4 years way too short? No. It is apt. In which case, if your investment horizon matches your Machiavelli's duration, your YTM will be the same as your original YTM as 15%. No sir, in the market the rate has become 14%, that is, it has become lower. Yeah, if it has become lower, my reinvestment will be at lower rate, but my price will go up. Well, at 4 years they will negate each other, and you will see that at 4 years, if you do all of this working, you will land up ultimately with a 15% return only. There's a long calculation. Or if the rate becomes 16%, then I would say that the market price will fall because interest rate is going up. But the fall in market price will be offset by the additional reinvestment at 4 years. And even over here at 16%, if you sit, you will say that if I sell after 4 years, what will be the price? Maybe 95.69, maybe a lower price I'm getting. But this 11 that I got in the first 4 years and I'm reinvesting, that will give me a good return, and ultimately I'm landing up with a 15% return. So long story short, ideally your investment horizon, if you want to sleep in peace and you want to kind of say that the price risk or reinvestment risk should not affect me, then your investment horizon should be equal to your Machiavelli's duration. Sir, but what if there's a duration gap? That is, your investment horizon is, for example, only 2 years, whereas Machiavelli's duration is 4 years. That means there's a duration gap, 4 minus 2, that is 2 years. In which case, you will bear more of the price risk, because if the interest rate increases, price will fall, that will be a higher risk that you bear. Or if your investment horizon is greater, that is, your duration gap is negative, your investment horizon is 4.5 years and your duration is 4 years, 4 minus 4.5, that is negative 0.5, in which case you are investing for longer, in which case you are bearing higher reinvestment risk. So over here, if you look at this, possibly you will see that risk in bond which is sold prior to maturity, there are two risks. One is the coupon reinvestment risk and one is the market price risk. Okay, in scenarios where the investment horizon, let's say is 4.5 years, is greater than the Machiavelli's duration, let's say is 4 years, that is, your duration gap is negative, then your reinvestment risk is the greater risk. Okay, whereas if your investment horizon, let's say, is 2 years and your Machiavelli's duration is 4 years, that is, your duration gap is positive. 4 minus 2, Machiavelli's duration minus investment horizon is a duration gap, it is positive, in which case your price risk is your greater risk. But if it is exactly equal, then these risks kind of offset each other. So Macauley's duration minus investment horizon will give you the duration gap. You can remember from an MCQ perspective that if the duration gap is positive, that means your Macauley's duration is 4, investment horizon is 2, in which case you are bearing more of price risk, and if your Macauley's duration is negative, you are bearing more of reinvestment risk. Well, this is quite intense, I would say. It's best if it is done with numbers, but then it will take a lot more time. If you have already revised, if you have already done sitting and solving those sums, will take even more time. So I hope you have some grip of these things that we are reviewing. Calculate and interpret Macauley's duration. Well, you can combine this with the next reading as well. So in the next reading, you will have something like modified duration. So when you look at a modified duration, the formula for modified duration is a Macauley's duration divided by the 1 plus YTM. And the significance of this modified duration is that it will help me showing how sensitive the bond price is in response to a change in the market rate. Like for example, if you carry forward the same example that we were doing, the Macauley's duration came to 4 years, and in that the YTM was 15%, in which case if I were to find the modified duration, which is like a regression coefficient, I would say 4 divided by 1.15. So if I were to do 4 divided by 1.15, that is around 3.48 or 3.5 as a case may be. Now what does this number signify? It signifies that if there's a 1% change in interest rate, 1% change in interest rate, the bond price will change by 3.5% approximately. This is kind of a linear change. Practically there would be some curve effects, so there will be some convexity, but for the timing this is considered to be, let us say, a linear change. So I will again repeat, what does the modified duration, how do I calculate it? It is a Macauley's duration divided by the 1 plus YTM, and what does that number signify? Let us say this is 3.5, then the 3.5 signifies that for a 1% change, a change can be an increase in interest rate, then the bond price will fall by 3.5%, or 1% change can be a decrease in interest rate, in which case the bond price will increase, let us say, by 3.5%. So this is a brilliant way to find that what will be the expected bond price, assuming this relationship holds true. Like for example, in my earlier example, the bond price was 86.59. However, I believe that looking at the scenario, the Fed or the RBI as a case maybe is going to increase the interest rates from 15 to from the prevailing 15% to, let us say, 15.5%, in which case one option is at 15.5%, you take your financial calculator, let's say initially only this happened, you take N as 5 years, coupon you take as PMT is 11, future value is 100, present value you want to find, I by Y now is 15.5%. You sit and calculate, that is the intrinsic value. Other option is, you are saying that if today the price was 86.59 and the market interest rate is likely to increase, that means the bond price will fall. Achha, bond price will fall by how much? Well, it will fall by 3.5% for a 1% change, but this is not a 1% change, this is a 0.5% change. So we are saying that for a 0.5% change in interest rate, this is how much? Into 3.5% approximately. So 0.5 into 3.5 comes to, let's say, 1.75%. This will be reduced. Why? Because if the interest rate increases, price falls. So let's say this is 3.5 into 0.5, this is 1.75%, 86.59 minus 1.75%, which will approximately come to around 85.07. This will be your impact. So over here, let's see, you can take 15.5 on the financial calculator, will come to around 85.09. However, if you do the working, for a 1% increase, there's a 3.48% fall. For a 0.5% increase, it will be around 1.74 or 1.75% fall. And hence, the percentage change in price can be calculated as the modified duration into delta YTM, and hence it comes to approximately 85.08. It did not come to be exactly the same because the price change is not linear. We are assuming it is linear, that for 1% change 3.48, 2% change 3.48 into 2, 3% change 3.48 into 3. We are assuming a linear change, but in practice, if you see, the change is curved, and that curve is convex in shape. That is a relationship of something called as convexity, which we discuss in the next reading. So over here, this is your impact on price. There is also an alternative simplified way to calculate modified duration. That is, you are going to take your current value, let us say 15%, and then take the price, if there's a decrease in YTM from let us say 15 to 14, in which case the price is 89.7, or there's an increase from 15 to 16, in which case the price is 83.63. So that difference shows you a difference over a 2% change, for example, and hence this is 2 into 86.5, 2% meaning 1% change on either side. So over here, this is divided by 2V0 into delta YTM. This is a concept that is used in reading number 59, specifically when you calculate something called as effective duration. So actually modified duration, actually it should be calculated by first calculating the Macquillet's duration, but that's a time consuming affair. Divided by 1 plus YTM, that is the best way. An approximate way would be, well, you have been given the current value, based on that you increase the rate by 1% and find V plus, decrease the rate by 1%, find V minus. You will find two values, take the difference divided by 2 VO into the change in YTM, that is let's say 0.01, and that will give you approximately the same. You can see 3.5, and that you can use as modified duration, because if you're running out of time, this is a good hack. In fact, this is very helpful when you study the effective duration concept in case of reading number 59 as well. So that is regarding modified duration. Now there are, so modified duration is reviewed over here. Modified duration, Macquillet duration by 1 plus YTM. Then this is an approximate way to find the modified duration, and we are saying that if YTM falls, then what will be the price? If YTM increases, what is the price? That is about it. So there is also one more concept of something called as money duration. It is not as important from an exam perspective. Money duration is nothing but duration calculated in dollars. So once you find the modified duration, for example, if you want to find the money duration, calculate money duration of a coupon of a bond with $2 million par value, has a modified duration of 7.42 and a full price of 101.32, expressed as a whole bond which is $100 value. Now I know 7.42 is the duration, but that is like the modified duration. I want to find it in money value terms. So I will say that on a per bond basis, one bond is worth $101.32. 101.32 into 7.42, that is your money duration on a per bond basis. If I want to do it on an overall basis, well, overall basis there are 2 million, that is 20 lakh of bonds, divided by 100 into 101.32. So 2 million into 101.32 into again 7.42. This will give you a big number. This is a money duration, not very important, but if it comes, you should know कि money duration में करना क्या है. It is your modified duration into the bond price if you want to do it on a per bond basis, or modified duration into your total bond value if you want to do it on an overall basis. ठीक है. So this is your money duration, and you can actually try to find the impact on an overall portfolio basis looking at the money duration, like what will be the impact of a 25 basis increase in YTM. So if I find the money duration, I will say that whatever is the total money duration into 0.25%, that is 0.0025, this will be your bond value. So this is just about it when it comes to money duration. Also there is something called as price value per basis point. What do you mean by this? Well, you will try to find for a 0.01%, 1 basis point is 0.01%. So you are saying that, okay, modified duration tells me that for a 1% change, what will be the impact in percentage? Price value of a basis point says that for a 0.01% change, what will be the actual money value impact on the price? Not just percentage, what will be the actual money value impact on price? So for example, if I don't know, over here there is no separate number, but let's say over here, if you want to find basis points, you are saying for 7.42 is the modified duration, but that is the impact on 1%. So 7.42 divided by 100, can I say this is 0.072 for a 1 basis point change, and the bond price is 101.32. So 101.32 into 0.07, so this is a 0.075 price impact for a 1 basis point change. So this is easy for a practical scenario where someone says कि भाई ठीक है, modified duration is 7.5, 7.5 is showing me the percentage change for a 1% change in interest. But usually RBI Fed, they don't change interest rate directly by the full 1%. Maybe you might have heard sometimes 25 basis points, 50 basis points, etc. So I want to figure out that if there's a change in 1 basis point, then what is the impact? So it's quite easy. If 7.42 is for 1%, 7.42 divided by 100, that is 0.0742 for 0.01%, but this is still in percentage. Okay. So the bond's price is 101.32. 101.32 into 0.0742 will give you the actual impact on the price. That is a 0.075 impact for 1 basis point. So if the change is 25 basis points, then 0.075 into 25, this will be a 1.75 impact on the total 101.32 bond. Okay, so this is regarding reading number 57 by and large, where you study the concept of modified duration, study the concept of the impact that modified duration has on price. That is usually my negative modified duration into delta YTM, because there's an inverse relationship between YTM. So if the YTM is increasing, the bond price will fall. So modified duration negative into a plus 1%. If the modified duration, if the YTM is decreasing, so negative 1% into, again modified duration is negative, negative will become positive. So if there's a decrease in interest rate, bond price will increase. So that is the impact on price. Also, something is money duration. Money duration is nothing but your modified duration into the bond's value, either on a per bond basis or on a total basis, and price value per basis points. That is the impact in percentage on a basis point change into the bond value, and that's about it. Okay. Now, in this very stressful section, you have another 2 readings. One is on convexity, and then is on effective duration, effective convexity, key rate duration, and that kind of will take care of this section, and then you move into credit risk and asset-backed securities. It is indeed a fairly difficult reading when it comes to fixed income. Okay, so we'll go into convexity, and just a small thing regarding duration as well. If you want to build a relationship between duration and bond features, like higher the bond maturity, higher will be the duration. Higher the coupon, faster will be the recovery, so lower will be the duration. Higher the YTM, then again lower will be the duration. There will be an inverse relation, because higher YTM will make the later years having lower present value. So basically, longer the maturity, longer the duration. Higher the coupon, lower the duration, inverse relationship. Higher the yield, lower the duration. So long story short, duration and time period, maturity have a direct relation. Coupon rate and yield with the duration have an inverse relation. Okay, then you go to convexity. Now the problem in case of duration is it assumes that the price change is linear. However, if you actually take any bond, a numerical example, and you try to find the actual price after a, let's say, 1% change in interest rate or a 2% change in interest rate, it will not exactly match the price as calculated and predicted by modified duration, and there will be certain difference, but the difference is in such a way that if the yield increases, that is, the price will fall, then the fall as predicted by duration will be much more than the actual fall. The actual price will be slightly higher, and if the yield falls, that is, the price will increase, then the price as predicted by duration will be lower than the actual price increase. You can actually sit and calculate. There are numericals where you can sit and calculate over here, in which case, let's say 100 was the price today when the yield was 8%. You go from 100, you go from 8 to 9%, that is, there's an increase in yield, so price will fall. The price falls from 100 to 90.79, so that is a fall of only, I would say, 9.21. Duration predicts something else if you calculate. However, when the price increases, the increase in price is much more. That is, it goes and increases by 10.67, and hence that makes this nature of curve convex. This is concave, this is convex. So this makes it convex, and because it is convex, that number is convexity. Now, what is the reason? The conceptual reason over here is duration. Let's say we found at 3.5, but we also studied that as interest rate changes, duration also undergoes a change. It will not remain at 3.5. As interest rate changes, duration will also undergo a change. But when you try to predict the price, you say at 1% change, 3.5%, 1% change in interest rate, 3.5, 3% change in interest rate, 3.5 into 3. But as interest rate changes, duration also undergoes a change. Like duration is the first derivative. As interest rate changes, bond price changes, duration is the first derivative. If you look at integral and calculus, if interest rate changes, bond price will change, but duration will also undergo a change, and that is measured by convexity. So convexity is kind of this factor. The difference between the convex curve and the price as predicted by duration is the convexity. So when I'm looking at measuring convexity, there are two ways in which you do. One is a fundamental way where at each cash flow you will measure the convexity. So that is a much longer way which is not used in the exam. So over here, if you were to measure convexity, you will try to measure it at each cash flow. There's a formula T into T plus 1 into 1 plus R squared. That will give you the convexity for the first cash flow. Similarly, you will find the convexity for the second cash flow. Similarly, convexity for the third cash flow, fourth cash flow, fifth cash flow. You will find the convexity factor for each of the cash flows. And like you took for duration, you took the weighted average. Like in duration, you do T into PVCI upon summation PV of all CI. Here instead of T, you will take T into T plus 1 upon 1 plus R squared, and then you take the weighted average. This will give you a convexity of around 16.91. This is way too time consuming for a 2 mark, 2 mark meaning there is no specific marking, but for one MCQ to invest so much time and then to not come to a correct answer is very possible. So almost always you will use this shortcut. Like in modified duration also you have a shortcut. You can take V minus less V plus upon 2V0 into delta by TM. A small change over here would be V minus plus V plus. Sir, what is V minus? Maybe at 108, 110.67 for example, 110.67 plus 90 for example 79, let us say minus 100 into 2. So you are saying that ideally the movement should be linear. So let's say 10 plus 10 minus, but it is not linear. So what is that gap is what we are trying to find upon, let us say in the denominator V0, that is 100 into delta by t. Let's say this is 0.01, but because it is the second derivative, you will take 0.01 squared. And hence if I take this working, there are slightly different number sets over here. The number you will get over here will be approximately equal to this 16.91 number only. I have taken a different number set, 110, etc. But if you were to take this formula, you will get the convexity factor. So over here, if I want to find the true impact on price, I'll have to look at both the convexity and the duration. Convexity is approximately calculated as V minus V plus minus 2V0 upon delta by TM squared into V0. So this is convexity. Actually on a per cash flow you can do this and then find a weighted average. It is way too time consuming, and hence we will do the convexity directly. Okay. Price yield function of a callable option free bond, we will study that in the next chapter, which is on with embedded. So this is callable puttable, will come that in reading 59. The change in bonds full price, well, that can be measured as annual modified duration into delta by TM plus. Sir, plus why? Because the price as predicted by duration will always be lower. To that convexity will always add. Yahan pe bhi it is add, yahan pe bhi it is add, plus 1 by 2 into the annual convexity, that is 16 point whatever you calculated, into delta by TM squared. Sir, why? Duration was delta by TM because it is the first derivative, but convexity is the second derivative. It's like dy by dx squared, and hence you take delta by TM, that is squared. If I were to kind of wrap this up in a fairly nutshell without going into integral and calculus. So this will always have a positive effect, and this will show you the actual full impact on price, considering the duration number as well as considering the convexity both. Okay, so when you look at, for example, this, you will have to practice a bit on convexity. Duration is relatively more important. Now, question might also ask you to calculate portfolio duration. Now, portfolio duration, there are two ways. The first way is, if your portfolio has 5 bonds, you will try to find the aggregate cash flows that are generated through coupons principal in the first year for all the bonds, then aggregate cash flows for the second year, all the bonds, third year, all the bonds, and so on, and then find the duration like you did in the regular way. Now this is very time consuming, and at the same time for a big portfolio can be very taxing to do. And hence another way would be taking the weighted average. If your bond has 5 portfolios, you find the duration for each of the portfolios, each of the bonds. Let's say there are 5 bonds. First bond has a duration of 3.5, second has a duration of 5.25, third has 7.5. You'll find the duration for each of these bonds and then do the weighted average. Your portfolio comprises 20% of bond A, so 3.5 into 20%, it comprises 30% of bond B, well 30% into 5.25, and so on. So that is a much more practical way. Almost every time if you go to a fund management firm, they will always be doing weighted average duration, taking duration into the weights, and that will give you an adequate measure for finding the duration value. So theoretically, the first way is a good way, where you take the portfolio's aggregate cash flows and you try to find. So you will take the weighted number of periods, taking portfolio's aggregate cash flows. Theoretically that is good, practically very infrequently used. And weighted average duration is duration of individual bonds. You will take the YTM of every bond, you will take the weight of bond 1 into duration of bond 1, weight of bond 2 into duration of bond 2, weight of bond 3 into duration of bond 3, and so on. The only problem that arises in this case is when you look at this type of duration, what they will do is they will calculate the duration well for a parallel shift in the yield curve. Like for example, if the yield is across all the tenures and for all the bonds change by 1%. Now that may not necessarily be the case. Maybe it is possible that the shorter duration bonds change by 1%, longer duration bonds change by 0.25%, and hence that may not be the best way always, but it is a very acceptable way. This will give you a good measure of the portfolio duration for a parallel shift in the yield curve. Parallel shift in the yield curve means across all maturities there is a change of, let's say, 0.5%. Shorter duration bond also changes by 0.5%, longer duration bond also changes by 0.5%. However, if there is a non-parallel shift in the yield curve, like the shorter duration bond increases by 0.5%, but the longer duration bond there's a decrease by 0.25%, it can happen. In which case, how will we solve? For that, in the next reading, you have a concept of key rate duration, where you will calculate, sir, kitne duration? Even I am fed up. Duration by duration, you will have further effective duration as well. Sorry, my sympathies are with you, but I can't do much beyond that. So over here, you will have, let us say, key rate duration for a non-parallel shift in the yield curve, and you can directly take your regular portfolio duration for a parallel shift in the yield curve. And that takes you to this last of this taxing headings, which is curve based and empirical fixed income measures. So over here what happens is, this chapter is specifically devoted to bonds with embedded options. Embedded options means there can be a callable bond, there can be a puttable bond. Now these bonds have options embedded inside. All the workings that we did till now were for straight bonds, option adjusted. They were straight bonds, there was no option. If there was option, you removed the effect and you found the values. But when you look at a callable bond, the challenge in case of a callable bond is, think of it this way, callable bond is a bond, listen to this very carefully, callable bond is a bond where the issuer can call back the bond whenever the issuer wants. Let us say I am an issuer, I issue a bond, today coupon rate is 10%, discount rate yield is also 10%. Now what, and the term is 5 years. Now what happens is, over the next 1 to 3 years, the market interest rates decrease. They come down to 9, 8, 7%. Now as an issuer, I am kind of cursing myself that why am I paying 10% when the market interest rate is 7%. Now if I have a callable feature, what I will do is I will call back the bond. The moment I see that the market rates of interest are following, I will refinance and I will call back the bond and give back the money to the investor. Kitna, let us say for $100, let's say the call price is set at 101, which means usually what happens is, if the bond price falls, if the interest rate falls, bond price will go up. I'll again repeat, if the interest rate falls, bond price will go up. Yes. However, in case of a callable bond, that going up is capped. It will not go up beyond 101. Why? Because beyond 101, people will say, no, we will not pay beyond that, because if the interest rate is falling, the issuer can call back, and if they call back, they will give me 101 only. Then why should I pay you a penny above 101? and hence there is an almost cap that is reached at 101 for a callable bond. On the other hand, if there's a puttable bond, like so what I'm trying to say, if I directly use these bond measures, it may not give you directly the price. If I look at a puttable bond, so over here this was a graph for a callable bond. If I also look at a puttable bond, what happens in case of a puttable bond is the option is with the holder. So the holder might say that if the market rate of interest increases, bond price will fall. Again, market rate of interest increases, bond price will fall. However, the holder will say, why am I stuck with this bond which is giving me 10% when the market rate is going up to 12 or 13%, and hence I will put the bond back. I will put the bond back and get the put price. Let's say the puttable price is 100, in which case ideally the market interest rate goes up, the bond price should go down. But in case of a puttable bond, it will not go down because of the puttable feature. So it's like a floor, it will not go down below the put price, because they know that even if the market rate is going up, they can put the bond back to the issuer and claim back later, say the put price, that is 100. So over here the thing is, in case of bonds with embedded options, it is very difficult to do the evaluation, and hence we'll have to do an approximate working, because the change in YTM, the delta, see, for modified duration, for convexity, we needed delta YTM, that is a change in YTM. But the problem is over here, a delta YTM of your bond may not necessarily translate into a change in that respective price. So because bonds with embedded options have uncertain cash flows, they do not have a single well-defined yield. Like we discussed, the delta YTM, if you remember, you had this yield to first call, yield to second call, yield to third call, yield to worst. There were so many yields. Delta YTM, which YTM are you saying? For bonds which are callable bonds, puttable bonds, they don't have a well-defined YTM. For other bonds, they can have a well-defined YTM, and hence you can say, okay, the YTM changes by 1%. But for a bond with embedded option, they might not have a well-defined YTM. Therefore, effective duration and effective convexity must be calculated. But how will I calculate? I will say, forget the YTM of the bond. Let me look at the government bonds curve, and if the government bond yield is changing, I will believe that my bond's yield will also change. But here the risk is I am ignoring the credit spread. Now government bonds yield will change, let's say from 5% to 6%, that will be due to inflation, etc. Then my bonds yield can also possibly change. But my bonds yield can also change due to microeconomic factors, that is my credit rating getting affected, but usse government bond ka it will not be captured. But here I cannot take my YTM because it is very difficult to find a single YTM in case of callable or puttable bonds, and hence, long story short, if there's a callable or a puttable bond, that is a bond with an embedded option, then in such a case what we will do is we will try to find the effective duration, and in effective duration the formula is still the same. That is, you will take V minus, then you will have V plus divided by 2V0. Instead of delta YTM, I will say delta curve, that is a government spot yield curve, for example. I will take as a base, and if there's a change over there, in response to that my bonds price will change. How much should it change? I will try to find over here. So over here, effective convexity must be calculated with respect to shifts in the benchmark curve rather than bonds yield with embedded options. Okay. Effective duration is again the same formula. If I go to see, it is the same formula, just that यहाँ पे delta curve आ जाता है, and even when I look at convexity, it is the same formula, V minus, V plus, minus 2V0. This is instead of delta YTM, I am taking the delta curve and V0. Callable bonds, MBS, have negative convexity at low yields. What do you mean by negative convexity? It means usually the curve goes like this. However, if it is a callable bond, what will happen is, if for example yield is increasing, market rate of interest is increasing, 10, say 12, 15% it is going, bond price will fall. But issuer will not call back the bond. He is happy that he has a bond where he is paying only 10% when market rate is 15%, and hence the bond price will fall. However, when the interest rate falls, usually bond price should increase like this. But issuer will probably call back if the market rate is falling. He will say, I will not pay a 10% interest when the market rate is now 6%. And hence he will call back. And what is a call price? Maybe 102. And hence the price is capped at 102. And hence there can be a negative convexity in case of a callable bond. In case of a puttable bond, there's no negative convexity per se. Why? Because if the market interest rate reduces, holders are very happy. They will not put the bond back. Bond price will increase. But if the market interest rate increases, the bond price should ideally fall. But it will be capped at the puttable value. So you can see that still that curve which is there. Yahan pe that curve is becoming negative. It is halfway through convex, but after that in callable bond it is going something like this. The shape is twisting, but the shape over here is not really twisting in the sense it is smoothing out, but it is not going to be a negative convexity. So long story short, you can remember for a puttable bond or an option free bond, the convexity will always be positive. But for a callable bond, and when you study MBS, mortgage backed securities, over there also the homeowners can prepay the mortgage. So there is a possible prepayment risk which is similar to a borrower paying early. So there can be a negative convexity. So over here, there can be, for example, a negative convexity. In an MCQ, you can possibly remember that for callable and MBS if the yields are falling, in which case the issuers can kind of prepay. Okay, calculate the percentage change of a bond for a specified change in the benchmark yield. It is the same formula. Well, the formula was, if I want to find the percentage change in the bond's value, I would say negative modified duration. And instead of negative modified duration, you will say negative effective duration into delta YTM ke badle, you will say the delta curve plus 1/2 effective convexity into delta curve squared. So over here, when you are looking at this, you will find the change in price for a change in the curve. But the problem is this can only accommodate parallel shifts in the curve. That is exactly across all maturities the changes are uniform. But practically it is very much possible that for a shorter duration bond, the interest rate change in the government spot curve is different as compared to the change in the long term bond, and hence for that you will try to calculate the key rate duration. So what do you mean by key rate duration? It is useful for non-parallel shift in the curves. Key rate duration is a sensitivity of the value of a bond to a change in the spot rate for a specific maturity in the spot rate curve. So basically when you want to calculate the key rate duration, you will try to find that for each maturity, let's say if there's a 5-year maturity, there's a 10-year maturity. For each maturity, what is the respective impact? And then when your bond has a portfolio of a 5-year bond as well, a bond has a portfolio for a 10-year bond as well, you will try to find the average considering both. I'm not sure if I have, let us say, a numerical for this. Let me just see if there is, it will be helpful. So when I look at, for example, I mean, we are just saying that in effective duration, wherever there was a delta YTM, I will take delta curve, and the same is the case even in case of impact on price. Okay, if let us say there was, just a second, convexity. Okay, so for convexity option free bond, it is always positive, to have a positive impact. With options also, puttable will be positive, call at a higher yield will be positive. It is only call at a lower yield where it will be negative. I'm showing this negative curve. Okay, there you have key rate duration. Just a second, we'll just try to do it with numbers, it is better understood. Let's say there is a zero coupon bond. There is a zero coupon bond, which means there's no coupons in those time periods. It's a 5-year bond, and then there is a 10-year bond. Acha, for a zero coupon bond of 5 years, because there is no coupon, the duration will also be 5 years. And for a zero coupon bond for 10 years, the duration will also be 10 years. And the current YTM is 5% and 6%. If I want to calculate the modified duration, I will say Macauley's duration divided by 1 point YTM. So this is 5 divided by 1.05. This is 4.76. Key rate duration for the 5-year bond, and 10 divided by 1.06, different YTM for different maturity, 9.43, that is fine. Now you have been told that a change in the curve has been a positive 0.5% for the 5-year bond and a negative 0.25% for the long-term bond. Then what is the possible impact? I am saying that, well, the duration over here we have found a modified, let's say there's 50% of the funds invested in this bond, 50% of the funds invested in the other bond, where I would say that, well, if there is a 0.5% increase, then I would say that negative 4.76 into 0.5%. This will be the impact on the first bond, and negative 9.43 into a negative 0.25%. Negative will become positive, will be the impact on the second bond. However, what is the proportion of the first bond? So the proportion of first bond in the portfolio is 50%. What is the proportion of the second bond? Let's say it is 50%, and hence if I were to do this, I would say that okay, there will be a 1.19% fall in the first bond, and there will be a 1.18% increase in the second bond, and hence the net impact will hardly be 0.01%. If I would have colored the entire bond by the same brush, I would say that if there's a 0.5% increase, everything is 0.5% increasing. Not necessarily. The 5-year bond is increasing by 0.5%, their yield. A 10-year bond yield is falling by 0.25% for whatever reasons. So I will try to find the durations respectively for each of these bonds, Macquaril's duration, then modified duration in a simple way, and then I will say that the portfolio duration, before I do weighted average, I will find that instead of taking delta YTM in general, by everything increasing, I will take 0.5% for the first bond and negative 0.25% for the second bond, and accordingly calculate the impact on my overall bond portfolio. So this is what is called as a key rate duration. Define key rate duration and its uses to measure. Key rate duration is a measure of price sensitivity to a change in yield for a specific maturity. 5-year different, 10-year different. Key rate duration can be used to estimate price sensitivity when there is a change in the shape of the yield curve. Earlier जो shape था, वो shape change हो जाएगा because shorter durations are increasing by 0.5%, longer durations are decreasing by 0.25%. This is when key rate duration is helpful. And the last part over here would be the difference between analytical duration and empirical duration. So when I look at analytical duration, all the durations and everything that I've done based on calculation is actually analytical duration. So everything that is done till now is all analytical duration. But actually, what you expect as a change in price, has that actually happened? Well, empirically means historically you will see when the curve or yields changed, and in response what was your actual change in bond prices, and accordingly you will find that sensitivity. If there's a 1% change in the bond in the interest rate, bond price will change by 3.5%. Analytically we think that this should be the case, but practically has that been the case? Okay, for a 1% change, what has been the actual change? Acha, the bond price has changed by 3.6%, for example. That is your empirical duration. So over here, usually for government bonds or bonds which are relatively risk-free, where spread is not that big a problem, then analytical duration is a good measure. However, bonds where spread, like the credit spread, etc., is a big angle, then empirical duration can also be seen in the past that on whether empirical duration is almost similar to analytical duration. Like over here, difference between empirical and analytical. Analytical is based on our mathematical workings, useful for government bonds. Empirical duration is historical relationship between the benchmark yield and the price changes. Because of the uncertainty, there can be a flight to safety. Like for example, in corporate bonds, especially high yield bonds, it is possible that if the market scenario is uncertain, the government bond rate will change only by 1%. But because of the uncertainty, the spread that you are demanding from the high yield bond will increase significantly. Possible. In which case, the impact will not be truly captured by the analytical duration, because analytical duration will just say, there's a 1% change in government bond rate, but that 1% change is resulting in a much higher impact on you because of the differences in spread that is happening. There is a flight to safety. People are selling your, moving out of these high yield securities. So that is what you can remember, that for corporate bonds, especially the high yield bonds, empirical duration should be seen. But for relatively safer bonds or government bonds, analytical duration, what you have done till now is relevant. From an exam perspective, you have to focus on only analytical duration, but you should know that there is something called as empirical duration. Okay, sir, we will kind of join our hands and pray that some of this goes into our head. It is way too much. I understand that. So we'll probably, this is the kind of end of second section. I know that I should ideally make separate videos for each of them, especially these concepts, because probably we have spent what, maybe an hour and a half or so discussing, or 2 hours approximately discussing these areas, but they warrant maybe some more. So probably we'll try to put separate videos for this section separately at a later point. But at least I believe that this should be helpful. We will continue forward into the next section, that is pertaining to credit risk. Okay. Okay, so now heading on to the last section of your fixed income, reading number 60 all the way up to 65, where the first 2-3 chapters we discussed regarding credit risk, and then in the later chapter securitization and asset-backed securities. So this is largely theory. There are a few numerical adjustments, but largely this is theory, and it is quite interesting as well as scoring. So let us get this done. So over here, let us see if we can just pull up a few interesting charts. So what do you mean by credit risk? Credit risk refers to the risk that an investor is bearing, that the issuer, that is the borrower, will kind of default. Like Kingfisher Airlines, they kind of defaulted on their principal or interest, and as a result, this is credit risk. Remember, credit risk is not measured by things like duration. I mean, duration looks at the tenure, the coupon, etc. However, what is the possibility that this borrower, even if the loan is for 5 years, can possibly default? In which case, that risk is measured as credit risk. Now, how do you measure credit risk? There are a lot of qualitative and quantitative factors. Usually, that is stacked up into 2 parts over here. First is something called as bottom-up evaluation, which is looking at company or borrower specific factors, and second is the top down, where you are looking at the general macro factors. I mean, you don't have to remember the theory per se, but the 5 factors which affect the company are the 5 C's. The company's capacity to pay, so does it have the ability, does it have the resources, that is second, the capital, the resources or the amount to pay. Third, does this borrowing have collateral? Like if it is a secured borrowing, there's collateral, then you look at the quality of the collateral as well. Fourth is covenants, that is the conditions that is attached, like are there very strong negative covenants, that is you cannot sell assets, etc., because you can sell assets and you can pay off the borrowing. So look at the covenants, and last is the character, that is integrity or the willingness. Sometimes it is possible that you have the ability, you have the capital, but niyat nahi hai, like you don't have the willingness to pay. So these are the 5 important factors which you look at the company level. Then at the general macroeconomic level, you will again look at the 3 C's. First is the overall condition, like if it's a good macroeconomic condition, usually debt gets repaid, but in a bad condition, people might kind of face difficulty and debt repayment might be difficult. Second is the country, if it is facing certain geopolitical crisis, like let's say you are in a war or there's a political turmoil or a coup or a military dictator is taking over, so you will look at that. And third is the currency. If usually you are like the US or Europe, which have very stable currency, then it is much more easier to manage their debt and hence less credit risk. But if your currency is very volatile, like in a Zimbabwe or a Sri Lanka or a Turkey, for example, where there is a lot of volatility in their currencies, in which case it is very difficult for them to repay because their currency itself is not going to have the required value. So these would be the factors that you will consider, at least on a theory level, for assessing the credit risk. Now in general, let us say these are the factors that we will consider, but when I look at the capacity to repay, the capital, from where will I get the resources to repay? The sources of repayment, usually in case of a secured debt, the sources of repayment are the operating cash flows of the company or the collateral which can be used. In unsecured, well, it is only the operating cash flows because there's no collateral to fall back on, and if it is overrun debt, as we have discussed earlier multiple times, it will be from the general taxing powers, and if you don't have enough tax collections, maybe you can take additional debt or print new currency in order to service the existing debt. Now, when we are looking at other factors, in case of credit risk, we will also look at situations where there's a difference between illiquidity and insolvency. Insolvency is when you are not able to pay. Illiquidity is when your debentures don't have enough trading volume and hence they don't have enough buyers if you want to sell. in case of a bond indenture or a bond contract, there can be clauses like the cross default clause, like we discussed earlier. That is, if there's a default in one category of bonds, it will be considered as default across the categories, or a pari passu clause, where your debenture will rank in equal rights as compared to other holders of debentures. Now, this is the initial theory part. The more important part over here, I would say, is the second part, where you are trying to measure the credit risk. So when you're trying to measure the credit risk, how will you measure the credit risk? There are two very important terms. First, there's something called a probability of default. It is like asking you that what is the probability of you clearing your CFA level 1. You are prepared well, then the probability of failing is quite less. If you are kind of not as well prepared, I mean, it may sound harsh, I'm sure you will clear, but let's say then the probability of clearing is lower. So it depends on the facts, like a lot of factors. You will find that what is the probability of default. Now, usually we will say that if you are a very stable company, the probability of default would be less. If you are a very startup, a very uncertain cash flows, your probability of default may be high. We will see the factors that affect the probability of default. So one is the probability of default. Second is, if you default, how much will be the loss given the default. So for example, if there's a $100 loan, how much will be the loss if there's a default? Now, it is not necessarily the entire $100 will be lost. Probably if it is a secured loan, out of $100, I can cover $80 from the collateral. Out of the remaining $20 also, $10 can be collected. So $10 will be the loss given the default. So there are two things. One, you look at the probability on whether there will be a default or not, and second is the loss given default. Probability of default is usually measured as a percentage. Loss given default, you will have to see whether it is given in dollars or in percentage. You can do it either wise depending on the facts given. So when you look at the expected loss, let us say if you have to measure the expected loss in dollars, then you will do that by multiplying the probability of default with the loss given default. It is like saying that, for example, if there is a $100 loan, and if there is a default or there is no default, I'm saying that if there is a default which has, let's say, a 5% chance, no default has a 95% chance you will not default. 95% chance you will not default, in which case the loss will be 0. But if you default, maybe the loss will be $10. As we said, secured hai, there is some security and all of that, it is 10. In which case your expected loss, if you go to see, is 5% of 10 plus 95% of 0, that is equal to, let us say, around 0.5, and hence that is your expected loss. So when you're doing this expected loss calculation over here, I mean, we have given another example also over here, we could have referred that, but these are the two factors that you will consider. Now, when I look at recovery rates, that is exactly opposite of the loss given default rate. Like, for example, if the loss given default is 10%, that means the recovery rate is 90%. You can recover 90% of the loan, that is the loss given default is 10%. Or I can other way around says that if the recovery rate is given, like the recovery rate is 90%, then 100 minus 90, that is 10%, is the loss given default. So recovery rate is a percentage to be recovered on default. Loss severity is a percentage not recovered, that is 1 minus the recovery rate is the loss severity, also called as the loss given default in percentage terms. Now, sometimes what a very interesting thing is that when we take a loan, usually there is some compensation. Let's say if I look at a floating rate instrument, the compensation is the market rate of interest or market reference rate. Let's say that is 5%. It is compensation for inflation, time value, etc. But usually when we take a loan, we are taking a loan at 5% plus something. So that is the credit spread. That is the spread, that is the excess amount, because there is credit risk. And how will you measure this credit risk? Well, by this working earlier, that is probability of default into the loss given default percentage. So for example, if the probability of default is let's say 5% and the loss given default is, for example, I mean, it can be anything, it can be, let's say, 70%, in which case you will take 5%, that is 0.05, into 70%, that is 0.7, and then 0.035, that is 3.5% is your credit risk or a credit spread. So over here, if I look at credit exposure at default, that is total amount due minus the value of collateral. That is, for example, in our case, if there's a $100 loan, collateral is 80, then exposure at default is $20. Loss given default is expected exposure, that is $20 into 1 minus the recovery rate, let us say, which came to our $10. Ideally, credit spread is approximately equal to the probability of default into the loss given default percentage, that is the expected loss in percentage. in our case, let's say probability of default, let's say it's a different numerical set. Your probability of default was, let's say, 5%, and your loss given default was, let us say, 70%, in which case if I multiply, this will come to around 3.5%. This is your credit spread, which means if there is a market reference rate plus 3.5% should be ideally your rate. However, if your rate is 4%, in which case as an investor you are more than getting compensated for the credit risk. 3.5 would be your ideal compensation, you're getting 4 extra. Or if it is market reference rate plus only 2%, then you're not getting adequate compensation. So over here we mentioned that if the credit spread is greater than the expected loss, like credit spread is 4% when the expected loss is 3.5%, you're getting more than fairly compensated. On the other hand, if your credit spread is lower, let's say it is just 2% when the expected loss is around 3.5%, then you are not adequately compensated for the credit risk. Okay, so there's an example over here. If we kind of review that, there's a 3% probability of default, recovery rate is 75%, and you have to assess the credit spread. Over here, YTM is equal to coupon is equal to 4%, and the government security is 2.5%, which means the difference between 4 and 2.5, your actual credit spread is around 1.5%. So difference between 4 and 2.5, that is your actual credit spread. Government bonds are giving 2.5, this bond is giving 4%, so 1.5% is your actual credit spread. Now as per the expected loss, what should be your expected loss? So this is 3% into recovery rate is 75%, which means loss given default is 25%. So this is 3 into 25%, which comes to what? 0.03 into 0.25 comes to around 0.75%. Now I am okay if you gave me 0.75% over the market reference rate, but you are giving me, let's say, 1.5%. So this is a more than required compensation. You are more than happy getting this compensation. You are more than compensated for the credit risk. If you look at assessment on what are the factors that you should look at for probability of default, it is largely based on the capacity to repay. There are a lot of financial ratios like profitability ratios, like an EBIT margin. Higher the EBIT margin, higher cushion you have to pay the interest, and hence the probability of default will be lower. Or you look at interest coverage. Interest coverage also higher the better. If there is EBIT divided by, let us say, interest, if that is higher, again you have a lower probability of default. Leverage, debt to equity, debt to EBITDA, lower it is, the better it is, so that will result in lower probability of default. And cash flow to net debt. So these are various ratios which the institute has given you. Certain ratios are profitability linked, like you will have EBIT margin, higher the better, then there will be lower probability of default. Certain ratios are coverage linked, like interest coverage, again higher the better. Higher it is, lower will be the probability of default. Certain are leverage ratios, like debt to EBITDA, debt to equity, or even cash flow to net debt type of ratio, in which case you will look at the respective ratio, like leverage ratios, debt to equity, etc. Lower the better. Cash flow to net debt, higher the better. And accordingly you will look at these different ratios and assess qualitatively that what should be the probability of default. Higher the credit quality, lower will be the probability of default. Secondly, when you look at loss given default, it is a function of what is the security that is there, whether this debt is secured, unsecured, it is senior, junior. More the security and more seniority it has, lower will be the loss given default. Okay, now when we look at the two categories of bonds, one is investment grade bonds, that is BBB and above, and high yield bonds, that is lower than BBB, in which case usually for investment grade bonds, you are usually looking at what is the probability that there will be a default. We are not going to go into that loss given default thing because it is an investment grade. So we are first worried on whether there is a change in the probability of default. But it's in high yield, well, there can be a possibility, in which case you want to figure out that if there is a default, then what will be the loss given default. So this is just for your understanding. As such, you have to look at both of them. So a higher emphasis will be on the probability of default for the investment grade bonds, and a higher emphasis would be on truly focusing on the loss given default in case of a high yield bonds. Okay, so that is one. There are a few other things as well over here, like the use of credit rating and credit rating agencies and their limitations. If I look at the credit ratings by Moody's, by S&P, as you can see, Moody's rating looks slightly different. S&P is different. We need to remember that these are ratings for senior unsecured debt. There is no security. So these are general ratings. If you look at the default ratings, it will be the rating of a senior unsecured debt. Non-investment grade starts from BB till BBB. You can see there is investment grade or Baa3 in terms of Moody's, and then from BB all the way up to D. This is a non-investment grade, also called as high yield or junk bond category. Okay, now when you look at the uses, well, credit ratings will help us in comparison across different companies, across different issues. Credit migration risk, that is, you can move from, let's say, AA to A or A to BBB. So this is change in your credit rating. So this will help us quantify the credit migration risk, and regulatory requirement is also there for a lot of cases to kind of publish your credit ratings. Okay, when you are looking at these two concepts like notching, structural subordination, we'll see that after a couple of chapters that is done over there. There is certain risk as well. Credit ratings, we have said that these are Moody's and S&P are the most common one, investment grade, high yield grade, the uses of credit rating, but credit rating comes with it attached risk because credit rating agencies are not always perfect, and hence there is this risk that if you purely rely on credit rating agencies and they might have not completely considered the risk parameters, then there is a problem. Again, credit rating lacks market pricing because if there is a event that suddenly happens, a credit analyst will first study the entire company, he will write a report, that report will get approved. By the time it gets published, a lot of things might have changed, so it is usually lagged. Credit ratings are actually dynamic, reports don't get updated as frequently, and event risk is very difficult to assess. Like if there's pending litigation, even a credit rating agency does not know how the litigation is going to pan out, and hence if you lose a particular case, you are likely to have a huge penalty and big problem, but a credit rating agency cannot forecast what a court will do, and hence there is an event risk which is also attached to credit ratings. Okay, describe the micro and economic market issuer specific factors that influence volatility and spreads. Well, yield spread, when I look at the yield spread, it is made up of liquidity as well as credit spread. Like for example, what we say is, let's say if the government bond rate, if the G-Sec rate was, let us say, 5%, and your bond has a yield to maturity of, let's say, 8%, which means there's actually a yield spread of 3%. We will say, why is this 3% happening? Probably because of credit, but also probably because this is no longer a on the run issue. It is on the run means it's a very popular issue and hence it is very liquid, but it is not necessary that every bond issue is liquid. It may be illiquid, in which case there will be a liquidity spread. Like if you have to trade in an illiquid bond, a buyer or seller would consider that, well, this bond is illiquid, and hence if it is illiquid, it will have a liquidity spread as well along with the credit spread. So over here we are trying to measure both the liquidity as well as the credit spread. Okay, when I look at the various factors affecting the yield spread, well, that is credit cycle, economic conditions. Like if you look at a good credit cycle, it's a good economy, in which case the yield spread is usually narrow, but in a bad economy it is usually more. Again, same as economic conditions, in boom the yield spreads are usually narrow, there's less credit risk, but in case of a recession they kind of widen, especially for the high yield bonds, because of a concept of flight to safety. That is, people will exit the risky bonds and try to move into the relatively safer ones. Broker-dealer capital, demand and supply, financial performance. So we will try to kind of assess this again. If I can just pull up a few calculations over here, like when you look at the credit spread, there are certain macroeconomic factors that you will look at. Like if there's a strong cycle, there's a lower probability of default and hence lower credit spread. If it's a recession, higher probability of default, higher spread. If you look at issuer specific factors, if the company you will try to compare with the average spread of similar bonds. If your company's average spread is increasing, that means your risk is increasing. Like you look at aviation sector and you are SpiceJet, GoAir, Indigo. Now Indigo is doing reasonably well, aviation sector is doing reasonably well, but GoAir is struggling. So GoAir's spread will increase relative to the other aviation companies, and market factors will include market liquidity risk, like the transaction cost for trading in bonds. How will I do that? Well, I'll usually compare the difference between the bid and the ask quotes which is quoted by the dealer. Usually the bigger the gap, it's like currency only, the bigger the gap, the more is the liquidity premium, the smaller the gap, lesser is the liquidity premium. So this is bid and offer spread. We'll do a numerical for this as well for a better understanding. When we are looking at, let us say, the differences over here for the investment grade versus high yield, the spread for investment grade will be lower because it has lesser risk. For high yield will be higher. Dispersion or fluctuation, again, for investment grade is fairly stable. There's not much of dispersion. For high yield, there's a lot of dispersion. For recession, usually it happens that high yield bond changes significantly because of a concept of flight to safety, because people would want to move to the safe assets and discard. They will try to discard and not buy the high yield assets. Factors regarding higher spread for high yield bonds are higher the risk, higher the returns. It is more of a capital equity type of a return. Okay, so we will go into the last part, which is market liquidity. As we said, wider the spread, higher is the trading cost between bid and offer rates, more the illiquidity. Lower the spread, lower is the trading cost. How do I measure this? Okay, so this is measured at, first of all, the yield. You will try to calculate the yield to maturity at the bid rate, yield to maturity at the ask rate, and the difference between the two is the liquidity cost. And whatever is the total spread, if you remove the liquidity part out of it, that will give you the credit spread. If I take a quick numerical, there's a 10-year bond with a coupon of 5%. Bid offer spread is 99.5 and 100.5. If you take the average, it is around 100, and the benchmark 10-year bond is around 3%. That is your benchmark rate. Over here, if you look at your overall spread, this is 5% and 3%. The difference is around 2%. That is your overall spread. Over the risk-free rate, it is 2%. Now, what I will try to do is I will try to find the YTM using my financial calculator at 99.5, the YTM, yield to maturity, at 100.5. Let us say if I apply that, and taking the midpoint, that is 100 as my average, I'll get YTM at 5.06%, YTM at 4.94%. So if I take 100, the YTM will be 5%. However, if I take 99.5, these are all the inputs in your financial calculator, I'll get 5.06%. At 100.5, I'll get 4.94. Why is there a difference? Because the dealer is offering separate bid and ask quotes because of the liquidity. And hence, the difference between 5.06 and 4.94, that is 0.12%, is attributable to the liquidity. However, the total spread is 2%, out of which 0.12 is due to liquidity. So the remaining 1.88% is your actual credit risk. So over here, this is only to be done if a separate liquidity adjustment or bid and offer rates are given. If they are not given, then directly 5 minus 3, that is equal to 2, is the spread. You will assume that is linked to credit risk. However, if there is certain bid and offer rates also specifically given, then you will say out of the 2%, maybe some part of it is linked to the liquidity. So you will try to quantify that, find the YTM at the bid, find the YTM at the ask. The difference between the two is your liquidity compensation. Perfect. So this is a slightly long, interesting, as well as a fairly detailed topic. So this takes care of reading number 60. Next we'll go to reading number 61, which is for government issuers. So this chapter has very few concepts. It is just generic when it comes to looking at the analysis for the government sovereign debt. So when you look at sovereign debt, this is debt issued by the government. For assessment, there are certain qualitative as well as quantitative factors. So when I look at the qualitative factors, it is assessment of the institutional policies, like the legal, the regulatory framework that is there in the particular economy, so that the relevant clauses can be, or the relevant date. So usually when you are looking at a government, if the country has strong judicial, institutional policy making, then you will consider that kind of investing money in that country is relatively safe. Secondly, you look at your economic assessment, certain other factors like even fiscal, like the government's ability to collect tax is also important. So if you are in a country like Dubai, for example, hardly any tax. So we will say that, well, if they are taking debt, from where will they repay debt? If oil dries up, from where will they kind of repay debt? So the government's ability to collect tax can also be seen. There is also monetary policy, that can the central bank or the RBI, let's say in our country, make changes just so that in case there is a problem in the economy, it can be managed. So there can be monetary policy, there can be fiscal policy, institutional setup, economic flexibility or economic indicators like how good is your growth trends, GDP, etc. will also be seen, because this is sovereign debt. You have to figure out selecting which country is more important than identifying a company in that country. So to get the country right is of paramount importance. Okay, then you will have other factors like currency or external factors like, is your currency a stable currency like a dollar or euro which is accepted globally? Other than that, you have certain quantitative factors as well, like fiscal strength, for which you will look at certain ratios like how much is your debt to GDP ratio, lower the better. Economic growth, how much is the GDP per capita growth, etc. And external stability, that is how much of forex reserves, etc. which are there. So when I'm looking at assessing a country, I will look at the institutions, the policies, the regulatory environment over there. I will look at the fiscal and monetary condition, the external reserve or external currency position, how the economic factors are there, at least on a qualitative side. On a quantitative side, I will look at the most important, the debt to the GDP ratio, the fiscal strength, other economic factors, as well as the external stability like the reserves, etc. Now when you're looking at non-sovereign bonds over here can be classified into 4 categories. First is agencies, like government agencies which are there, which are not really government, but in a way they are discharging a particular function assigned by the government. They are not technically government, but they are backed by certain guarantees given by the government. So in a way, they have a fairly competitive rate. Second is, maybe there are government institutions or banks, like for example in India you have SBI, etc. Again, it is not directly the government, but it is a government institution or a bank, so that is a non-sovereign debt. Then there is municipal bonds, which can be, as we have discussed earlier, it can be paid out of the general taxes collected, called as general obligation bonds, or collections from a particular project like a revenue bond. And then there is a supranational, like organizations like the United Nations or the IMF or the World Bank might raise funds by issuing bonds, in which case these are supranational bonds. So there's nothing much, to be honest, in this chapter. It is just a separate reading which can get done fairly quickly. Okay, so that is regarding for government issuers. Next you go into corporate issuers. So in case of corporate issuers, when we look at the analysis, there will be a lot of factors to assess for default in case of corporate bonds. We have discussed general factors when we discuss credit risk, like the capacity, collateral, etc. So then we went into government. Now we are going specifically to the corporate. Now when you look at the corporate bonds, there can be qualitative factors. Over here, when we look at, we prefer again high quality issuers which have high quality business model. So if there is a stable cash flow, if your business model is generating a stable cash flow, then that is considered to be a better parameter. Industry competition, the less the competition, like IRCTC has very less competition, then it is considered to be a better factor. Business risk, less the deviation, the better it is. Corporate governance, if there is sufficient processes to ensure that leakage of money or misappropriation by promoters does not happen, it is better. Debt covenants and accounting policies are to be looked at. So when I look at the qualitative factors, I will look at the overall business model, I will look at the nature of competition, I will look at the business risk that you are facing, as well as the corporate governance. In terms of quantitative factors, again you will look at certain ratios like the profitability ratios, EBIT margin, or the coverage ratios like interest coverage, or leverage ratios like debt by EBITDA or debt to equity, or even cash flow linked ratios like cash flow by net debt. So these are various ratios that you will look at. We will prefer strong profitability, lower leverage, high coverage, and high liquidity. These are the factors that is considered to be good for a high quality corporate bond. Now when we discuss the ratios, we discuss about these ratios. For profitability, EBIT margin is a good ratio, higher the better. Coverage, interest coverage, EBIT by interest, higher the better. For leverage, debt to EBITDA, lower the better. And for leverage or liquidity, residual cash flow to net debt, again higher the better. So these are various ratios that will be looked at for assessing the quality for a corporate bond. Now in this particular case, if you are looking at, let us say, some other things like we have mentioned, there can be capacity, collateral, covenants, all of these that we were discussing earlier, a few ratios as well, leverage ratio, coverage ratio. I mean, I'm just trying to give you the essence because otherwise this is more of a theory type of a discussion. And then there is the rankings of these bonds or instruments in terms of their seniority. So what happens is there will be senior debt and there is junior debt. Now, if it is secured, then it is best. So if it is secured senior debt, so that rests at the top, like this is called as a first mortgage or first lien debt. After that, you will have, so the first lien debt will come at the top in terms of hierarchy. After that is the senior secured, then is the junior secured. Very smart. After senior secured, you have the junior secured. After that, you have the senior debt. So you'll have first lien, then senior secured, junior secured, and then just the senior debt. After that, you will have senior subordinate. So here there is no security. Senior debt, subordinate debt. So these are unsecured, whereas these are secured. Remember, secured debt inherently has a better chance of getting covered. And in my hierarchy, I will have the first lien, secured, senior, junior, secured. These are the three. For unsecured, there is senior, unsecured. Then you will have senior subordinated, unsecured, then subordinated, and then finally junior subordinated. Now, we had said that we'll discuss a couple of concepts like structural subordination, notching, etc. Now, there's something called as a corporate family ratings, which means what happens is if Reliance comes out with its credit rating, for Reliance Industries as a whole, there will be a credit rating which is given for the company as a whole. However, there can be individual issues that Reliance does. Some of the issues may be senior secured issues, some of them may be subordinated, some of them will have a good collateral, some of them will not have as much of a good collateral, in which case the issuer specific ratings can be different from the corporate family ratings. Corporate family ratings is the rating for a group, for a company as a whole. However, every issue in a company might have a different rating, and as a result, your individual ratings can be different from the overall corporate family ratings. Okay, so if your individual ratings are going up or down, as let's say your corporate family ratings are AA, but this particular issue, your rating, because there is poor collateral, etc., is only A. So it is like notching the rating of your individual issue a notch lower. Or if your issue has fantastic collateral, the company in general but has okayish, but your issue has fantastic collateral, in which case your specific individual issue of that company has a AAA rating, that means it's a notching upward. So this is the process of notching, where the corporate family ratings, that is the rating for the group or the company as a whole, is different from the rating of the individual issue. It can be up or down. That process is called as notching. Or there's structural subordination. What happens usually is in case of a parent subsidiary structure. Now parent may be just a holding company and there is a subsidiary company. Parent has issued bonds, subsidiary has also issued bonds. Where will the parent get money? Well, usually it's a holding company, so it will get money from the subsidiary in the form of dividends, etc., and from that it can pay off the bonds. However, subsidiary has also issued bonds. So what happens is parent's bonds will be repaid out of the cash flows received from the subsidiary. However, the subsidiary also has bonds. Now, the subsidiary cannot give out dividend till the time its bonds are kind of paid out. So, subsidiary's bonds will rank superior, at least in this example, as compared to the parent's bonds, because parent will get money only after the subsidiary and its bonds, respective bonds, are paid off, and hence there is structural subordination. The structure of the company is such that the parent bonds are subordinate to the subsidiary's bonds. So there are a few of these terms: corporate family ratings, that is a issuer's rating in general. There can be individual issue specific ratings, and then there is a notching, which is a process of taking your individual issue ratings up or down as compared to the overall family ratings. And then there is structural subordination, where it is possible that in the structure it is possible that one of the companies, like subsidiaries' bonds, are priority and parents' bonds are a notch lower. It is subordinate by the mere structure, because subsidiary cannot give money to the parent till the time its bonds are paid off. Okay, so this kind of takes care of this mini section of credit risk. So 60, which is on credit risk, 61 risk specific for the government issuers, 62 risk specific for corporate issuers, and then you finally go on into the last part of your curriculum, which is the last 3 readings which pertain to securitization, that is reading number 63, and then asset-backed securities 64 and mortgage-backed securities 65, and then finally that is curtains down on your fixed income. So over here we will first try to understand the process of securitization and then kind of try to look at its benefits for various of its participants. So maybe if I can just skip through a chapter or so and try to look quickly the process of securitization. So let us say there is someone like State Bank of India, SBI, which is like the originator of this process. So what happens in case of a securitization is this originator has a pool of certain assets like loans, for example. These loans are going to give you money in the future, but it needs money right now. So what it does is it creates a special purpose entity, SPE, or a SPV, special purpose vehicle, which can be called as a trust also, or sometimes issuer of the asset-backed security. So what SBI would do is it will bundle up, pool up its assets like loans, for example, worth 1,000 crores, and it will give it to its special purpose entity that it has created especially for this purpose. Now, because it is a separate company, this special purpose entity is only holding these assets, and as a result, this is in a way, this entity is bankruptcy protected irrespective of what happens to SBI, because now for this entity, it has only the assets as these loans and there is nothing else. So over here, in that case, it is having, it is kind of distinct from the originator. Now, for the special purpose entity, what it will do is against this bundle or pool that is there, it will issue certain assets called as asset-backed securities. Why asset-backed securities? Because these instruments that it will issue, they will get cash flows from the pool of loans. So for example, if I have a 1,000 crore loan portfolio, I transfer this to an SP, the SP will issue certain instruments to the investors. Now these are customized tailor-made instruments. These can be called as asset-backed securities because they will get cash flows. These instruments can be of various formats, but they will get cash flows which are directly from the cash flows of this asset pool that the special purpose entity has, and hence the quality of this asset-backed security that an investor is holding is directly linked to the quality of the asset pool or collateral that the special purpose entity has. So these are called as securitization. Now one will wonder that why are all of these entities entering into such a complex transaction? First of all, for SBI, these loans represented a pool of highly illiquid assets because they were going to give you money after so many years. Instead, I bundled them, transferred to an SP who got money from the investors immediately, and that money was given to SBI. So that is freeing up capital which it can use for further purposes or further lending. Further, because the loans move out of SBI's balance sheet, it will be required to have lower capital adequacy or capital requirements, and hence that is a benefit. Let us say for SBI, further for the special purpose entity, because it has ring fenced, protected itself from different. I mean, it does not have exposure to any other liabilities of SBI. Over here, the issuance cost can be relatively lower for the special purpose entity. For the investors, they will get access to these borrowings, these loans, this collateral pool, which they would not have otherwise got. Further, I can also structure the terms, customizing it to the requirements of each investors. We'll study the different types of residential, credit card, mortgage linked, various types of securities where there will be a lot of different unique terms like tranching, etc. You can structure this, and as a result, over here, securitization results in a lot of benefits for the issuer or the originator, someone like SBI in our example. This will be increased business activity because the capital gets freed up. They can use that capital for further lending. Higher profitability, lower capital reserves required because I've removed the loans from my balance sheet, and hence I don't have to keep that 16%, 15% capital adequacy linked to that, and it results in higher liquidity. Secondly, for the investors, that is the ABS holder, it is tailored to the risk and return. If I look at the various possibilities, like you'll study further interest only, principal only, structured asset-backed securities, it can be specifically tailored to your requirement, access to the collateral without having a need to manage. Because if I take a loan, I have to manage the loan. Here, as an asset-backed security investor, I don't have to do that. And there is liquidity because these asset-backed securities can be traded in the market as well. For the markets, it is better because it reduces the liquidity risk, because in general, these loans would be illiquid and now converting them into liquid assets. So for the economy of the market as a whole, it is improving the liquidity, reducing the liquidity risk, increases the efficiency in terms of pricing, reduces the overall financing cost, will be able to arrange money at a relatively lower rate, and maybe reducing the leverage as well. But the risk over here is, again, there is uncertainty on the cash flows from the collateral. Like collateral might give you steady cash flows, or it might even default, or there can be possible prepayments, as you will study in, let's say, the last chapter. For especially mortgage-backed securities, prepayment risk is one of the most important risks, because if the money gets prepaid earlier, the asset-backed security holders will get money earlier. You will say that is very good, money is coming back. But by that logic, why are you even giving loan? You are giving loan so that you can earn interest over a 20-30 year period. But if that money comes back in 5 years, well, there is a prepayment risk. So there is uncertainty in terms of cash flows, and also there is credit risk based on the quality of this loan pool, which is now going to be borne by the investors. Okay, so over here, this is regarding securitization. There is a lot of discussion done in your Schwezer notes regarding the possible benefits, the possible risks that come out of securitization, but a more detailed understanding of this concept can be attained once you move on into the next 2 chapters. So over here, there is an example that they have discussed in the material, which is like what we studied for SBI. There is a car company which is selling cars. It is also giving loans. It forms an SP where it is transferring these loans, whereby it gets money. This SP raises asset-backed security to the investors, and this opens up the capital for the automotive company. This is just an example which is there in your Schwezer if you are studying from Schwezer, but nevertheless you don't have to remember that example if you are broadly clear with the concept of securitization. A few other terms for securitization would be someone like a trustee. Trustee is responsible for managing this special purpose entity. Usually trustee does not hold any securities, and hence he is called as a disinterested trustee, because he does not really have any direct interest in the asset pool. He is responsible for overseeing whether what is promised, what is collected is passed on to the investors, collected timely, etc. This special purpose entity is usually considered to be bankruptcy remote, because it is housed in a separate company as compared to the SBIs, and there can be certain agreements like the purchase agreements which can be between SBI and the special purpose entity, or a prospectus that I will issue to the investors of this asset-backed security. On the back of it, they will kind of take this asset-backed security. Okay, so that kind of takes care of reading number 63 on securitization. Then you go on into 64, which is on asset-backed security, and then 65, which is on mortgage-backed security. So first we look at the general asset-backed security over here. So over here, before you go into the other types of asset-backed securities, there is something called as covered bonds. Now, what do you mean by covered bonds? Like when you looked at securitization, what happens is the pool of assets that were there with SBI, you transferred into a special purpose entity, which kind of raised money by issuing asset-backed securities. Covered bond, on the other hand, will be a bond which is also raising money on the back of collateral or on the back of the security of these same assets, but I don't transfer. SBI does not transfer this out into a separate special purpose entity. It keeps these 1,000 crore worth of loans in its balance sheet only. It goes out to lenders and it says, well, I want money, I'm ready to pay you interest. They want some security. I will say that the cash flow that I will get from these bonds, I will kind of use it for paying your bonds. So over here, these are called as covered bonds, where you will have the bond sitting on the company's balance sheet, it is not transferred out into a special purpose entity like a typical asset-backed security would be. Now in this case, what happens is the investors will have a dual recourse. First, they will have recourse to the security, that is from the pool of assets. If any cash flow is collected, they will get recourse into that, and if this pool falls insufficient, that your collateral or security is insufficient, you can actually go back and take money from the general operations of the company as well. So this is relatively better for the investor, where they are not just getting a safety that I will collect money from this collateral. If this collateral falls inadequate, I can also utilize the assets of the company to collect my dues. So these are called as covered bonds. So when we look at covered bonds, we have just kind of discussed a covered bond is similar to an ABS, but the underlying asset remains on the balance sheet of the issuing corporation, that is SBI. No SP is created. So over here a few features are: there is dual recourse, that is first you can have recourse to the collateral, but if the collateral falls short, then other assets of the issuer as well. There is no credit tranching. Tranching of credit we will study in some time, which is a typical feature of an ABS which is issued through a special purpose entity. We will study that credit tranching. It covers a pool which is not necessarily going to be fixed. So there will be a collateral manager. This collateral manager will ensure that it is managing this pool of collateral which is not going to be fixed. There can be certain 1,000 crore loans. Out of this, some loans get repaid, new loans are taken. We will have to ensure that we are providing at all times a security of around 1,000 crores. So over here, the pool keeps on changing, as opposed to an asset-backed security where the pool is relatively stagnant once it is transferred to the special purpose entity, and it is monitored by the third party. Now there is also something called as a hard bullet or a soft bullet covered bond. A hard bullet covered bond means if there is a default in one of the payments, it is considered to be default for the entire bond. In case of a soft bullet, it is said that okay, if there is a default in one, then you will buy additional time, let us say 1 year, and hence it is like postponing the default. So hard bullet says default if the issuer fails to make the scheduled payment. In soft bullet, you are postponing buying time if the issuer fails to make the scheduled payment. There's also something called as additional pass-through, which means if you are unable to pay the scheduled payment on time, then these covered bonds become pass through. What do you mean by pass through? It means that collateral से जो भी पैसा आएगा will automatically pass through to the bonds. वैसा actually नहीं होता. If there's a regular bond is different and its security is different. Security means collateral is different. Collateral से पैसा आता है, it goes into the company, and then company can apportion that money for bond repayment. But if there's a default and there's an additional pass-through clause, in which case, let's say the holder of the bonds get right to directly collect money. That is, that money collected from the collateral will directly pass through to the lender. So these are a few things. Then there is some typical credit enhancement features used in securitization. Credit enhancement means there can be three common things. First is over collateralization. For example, now we are going to the traditional asset-backed security example that we discussed earlier, that SBI wala example. Over collateralization means over here SBI transferred loans worth 1,000 crores to the special purpose entity. The special purpose entity, on the other hand, issued asset-backed securities only of 900 crores, which means 100 crores is still a buffer. That is, if this loan of 100 crores also goes bad, I have over collateralized, which means I have 1,000 crore worth of collateral against which I have to pay 900 crores. So that is credit enhancement. I'm saying higher the over collateralization, the safer it gets. So over collateralization, value of collateral is greater than the face value of the ABS. Second is excess spread. It means over here that, for example, the loans are going to give me a coupon, let us say, of 10%. However, to the ABS holder, I am promising to pay only 8%. Obviously, there will be certain fees, etc. But even after that, I am collecting 10%. And I am going to pay only 8%, which means I have enough buffer that if some of these borrowers don't pay, I still have enough cushion to service my 8%. So that is excess spread, that I know that my bonds are giving me 10%, I'm still entering into an ABS which gives, let's say, 8%. That is excess spread. And third is credit tranching. Now, what do you mean by credit tranching? This is a little complicated, where what you will do is you will structure the cash flows in such a way that, for example, one tranche receives cash flow earlier, one tranche receives cash flow later, and hence this is called as credit tranching. We'll try to understand this with the help of an example which is better applied. So over here, when you look at, for example, something like this, let's say there is there are these three tranches. We have said there is tranche 1, which is a senior tranche. For $100, they will get market reference rate plus 1%, second tranche is $30, market rate plus 3%, and third tranche, which is like the equity tranche, will get the balance residual. So that is $70. So now what has happened is, I have totally $200 of collections from each of these tranches. Now I'm going to collect money, but I could collect only $120. I could collect only $120. Now out of this $120, the first $100 will go to the senior most tranche, that is tranche 1. After that, I'm still left with $20 that will go to tranche 2, which means tranche 2 will have a shortfall of $10. Tranche 3, which is the residual tranche, will get nothing, and hence over here tranche 3 will get the entire loss. So this is called as credit tranching. Now we will say that everyone would love to have tranche 1, but tranche 1 will have the lowest interest, lowest return, because it is bearing the lowest risk. Now you are the type of the investor who wants lower risk, you go to tranche 1, but you will have the lower return. However, tranche 3 is the highest risk. Well, it's like the equity tranche. Like if these bonds are worth $250, and if I'm able to collect $250, then on a $70 investment, I would pay $130 to tranche 1 and 2, and the remaining $120 will entirely flow to tranche 3. So it is like an equity type of a tranche, residual, but well, you are getting a higher return, but there's a higher risk as well. So this is called as credit tranching, where this same from the cash flows from the collateral pool, you are tranching, you are installing into different tranches based on your based on the risk appetite of various investors. So you are kind of redistributing the risk. Now when we look at the next section, where they have given you two fairly detailed examples of a credit card based ABS, an auto ABS, that is a car loan based asset backed security, or a solar ABS. ABS सुनने में बहुत complex लगता है, but it is just an asset backed security, which means there was SBI. SBI had given car loans, 1,000 crore worth of car loans. You transfer these car loans to the special purpose entity against which they issued certain securities. So that is a auto ABS. SBI has credit cards, and there are credit card dues. They have a pool of 1,000 crores for credit card loans. You transfer to an SP, they issue SBS, it's a credit card based SBS. Or let's say India mein itna popular nahi, but internationally solar energy is very popular these days. So there are loans which people had taken for installing solar panels, solar loans. You transfer this pool of solar loans to an SP, and against that they are issuing. It is the same. In the next chapter you will study mortgage backed securities, where SBI has given housing loans, and housing loans are transferred. So basically mechanics are the same, it is just different names given, which because India mein itna popular nahi hai, you kind of feel it to be a little intimidating. So over here, when you are looking at these credit card or solar or auto mortgage backed security, asset backed securities, they can be something called as amortizing, where the principal is also paid in each installment, or non-amortizing, in which case just the interest is paid, principal will be paid later. Usually when you look at auto loans, they are usually amortizing loans where principal and interest are both paid. Credit card based ABS mostly are non-amortizing, that is first interest is paid, principal payments are appropriated for acquiring more loans, and then later the principal is being paid. It depends again on the terms and conditions of each asset backed securities. So that is regarding certain credit card or solar ABS. That is just a general, you don't see a specific question only from that specific concept, it is just a generic thing. And then you have something called as CDO, CLO, or CBO, collateralized debt obligation. Now when I look at collateral, these sound to be same. Collateralized debt obligation, what is it? Well, it is same situation as this SBI wala exam. Sir, this was securitization, yes. This is also called asset backed security, yes. Is this also called as collateralization? Well, yes. There is different hi-fi words being used. So when I look at a collateralized debt obligation, also called as a CDO, what is CDO? It is just a structured security issued by an SP against a pool of obligation. So that is same as ABS, yes, but it has slightly different features if you compare it against the asset-backed security. That is, over here a CDO is dynamically managed, whereas an ABS is static, it is passive. Like in a mutual fund you have a passive fund manager and active fund manager. In a CDO the collateral manager is very active. If there is a bad asset in that pool, then the collateral manager will sell that asset and maybe acquire some other new asset. This is going to happen in a CDO. But in an ABS, in a simple static ABS, if 1000 crores, let's say there were 100 borrowers who had borrowed 10 crore each, that is 1000 crores, those same 100 borrowers will continue in a standard ABS. But in a collateralized CDO, what will happen is there will be a collateral manager who will dynamically manage. He will say that, okay, there are 10 borrowers from this particular region which are likely to face some difficulty in paying. Before that happens, let me just sell these 10 borrowings to someone and in return buy some other loans from someone else. So there is a dynamic manager who is managing. So that is a CDO, collateralized obligation. They don't solely rely on the static collateral pool, which is what a static ABS would do, and there will be a collateral manager who is responsible for buying and selling as well. CDO, collateralized debt obligation, it's a pool of debt obligation which can be either CBO, where there are bonds which were issued and collateralized bond obligations, bonds of corporate and emerging markets, or CLO, collateralized loan obligations, where there are loans taken from banks and those loans are transferred. Now most of the times CLO is more popular, so there are loans which banks give because bonds to ऐसे भी liquid होते हैं. So CLO is on loans which are largely illiquid, which you transfer to an SP and generate money. So this is portfolio of leverage loans, which is more common. There can be different types of CLOs. There can be cash flow CLO, where you are going to collect cash and transfer that cash. So the agreement is to transfer the cash flow that is collected, or a market value CLO which is unique to CLO. It does not happen in ABS. That is, the collateral manager will buy and sell these bonds that are there, and whatever the market value changes के वजह से gains or losses, that will be transferred. Or a synthetic CLO, which is a little complex at this stage, but there are something called as credit default swaps or credit derivatives. Instead of taking position on direct loans, you will take a credit default swap position on that, and cash flows generated will be transferred. So basically, if I were to summarize, I would say that usually we study asset-backed securities in a standard fixed income. This SBI wala example, what is there is an asset-backed security that is issued, assets backed. Those assets can be credit card loans, it can be mortgage or housing loans, it can be solar panel loans, it can be automotive loans, it can be anything. However, if they are a part of securitization, that is asset-backed securities, there will be a special purpose entity created, and from that against the collateral over there you will be issuing. Now if, for example, there is an active collateral manager who is managing that in NSP, it becomes a CDO, collateralized debt obligation. If it is static, then it is a simple ABS. If I don't transfer it to the SP, then I keep it on my balance sheet only, then it is a covered bond, if I kind of try to make sense. And if the underlying over here is a mortgage, that is a housing loan, then next chapter you will study mortgage backed securities or MBS. Okay. So this kind of, I think, broadly takes care of most of this discussion. There are certain tests on collateral pool to protect from default. That is, how good is the coverage? Is the over collateralization margin proper? Is it properly diversified across sectors? But again, all of this also has its share of limitation. There is a possibility that there can be a possible loss. Okay. And then you move on into the last section of your fixed income reading, your never ending, I would say, fixed income reading, which is on mortgage backed securities and their returns. So when you look at mortgage back over here, they kind of focus on first residential mortgage backed securities, which is that same SBI securitization process that we discussed earlier, just that the underlying will be residential housing loans. Later in this chapter, you will study commercial mortgage-backed securities, where the underlying would be loans taken for commercial property like warehouses, like industrial complexes, shopping malls, etc., offices. So over here, first we'll focus on residential mortgage-backed securities. The process remains the same. The biggest risk when it comes, which is unique to the mortgage-backed security, is something called as a prepayment risk. Why? Because housing loans are really long-term loans. Credit card loans are fairly small, few months, weeks. When you look at, let us say, your auto loans, that is also for a few years. But housing loans go into decades. So you will take a 20-30 year, let us say, housing loan. However, currently you are in the early stages of your career. You don't know how much money you will earn, but you make reasonably good money over the next few years. You as a borrower say that I have enough money, then why do I continue with this loan? You end up prepaying the loan. So very few housing loans run for the entire 20-30 year period. So there is a chance of a prepayment, there's a prepayment risk, and while pricing a mortgage-backed security, almost always a prepayment risk will be considered. So what is a prepayment risk? Prepayment risk is principal payments will be made earlier than as compared to what is scheduled. So we'll say, what is the problem in that? Well, when I've done securitization, what I've done is I've said that, well, this pool has an average life of around 30 years. However, I believe there'll be a prepayment, and hence I believe on an average you will receive money back in 15 years. So investors are mentally prepared that, okay, I'm investing money, on an average I'll get back the money in 15 years. However, if for example market rate of interest falls, most of the housing loans are fixed rate loans, the house buyers would say that we are paying 10% rate of interest, for example, and the market rate falls to, let's say, 7-8%. In which case they will try to refinance their loans. That is, they will arrange money from somewhere and they will pay these loans because the excess interest will pinch them. And here what will happen to the MBS, mortgage-backed security buyer, is, well, when they thought that they had invested in a product which was going to give them around 9 or 10% for a good 15 years, they get back their money earlier, maybe in 5 or 6 years. And what will they do with that money? Well, they will have to invest it now in a low interest rate environment. Well, they will get a lower rate, and hence a big risk. This is called as contraction risk. Contraction risk means you expected, well, the scheduled life may be 30 years, but you expected that the payment will come in 15 years. However, it came earlier, in which case your life got contracted. Usually this will happen in a low interest rate environment, in which case the investors will get money which they will have to deploy at the lower rate. On the other hand, it might happen that the market rate of interest shoot up. From 10% they become 12, 13, 15%, in which case the home buyers will not pay early. Well, you thought that on an average they will pay in 15 years, they will continue because the interest rate is high, in which case what will happen is you as an investor will end up getting 10% when in the market the rate is around 12 or 15%. In fact, you thought you will get it in 15 years. Now it will go even longer, and hence that is a risk. In fact, if you want to find the value of any debt security, whether it is a bond or an asset-backed security, you say it is the value of the present value future cash flows. Now if I have to do the discounting will happen at a higher rate. I know there's a lot of technicality, but this is what it is. If I were to do a quick overview, there will be a higher discount rate, and hence there will be a lower value. So usually this risk is extension risk. Usually when the market rate of interest goes up, it is possible that the home buyers will pay money later, in which case there's a possible extension risk. So these are the two risks which an MBS holder especially bears. If the buyers over here, principal payments in excess of scheduled, if buyers sell their homes or refinance their mortgage, MBS includes assumed prepayment rates. Let's say instead of 30 years we are saying 15 years, but there's an extension risk if the prepayment is lower. That is, they continue to pay and it goes 20 to 25 years. In this case, investors have to wait longer. Usually this will be when the market rate of interest increases, and refinancing is usually unlikely. The risk for the investor is cash flow will be discounted for a longer period and at a higher rate. If you look at contraction risk, prepayment will happen faster. Usually this is when the market rate of interest goes down. So investors will get money faster, but they will have to deploy it in other investments where the market rate of interest is lower. So cash flow received early will have to be deployed in low market rate of interest environment. And MBS does not run in tandem with other fixed interest securities because of this possible call risk. Okay, so this means that other fixed interest securities kya hoga? If the interest rate in the market goes down, the bond price goes up. However, in MBS, people are cognizant that even if the interest rate is going down, bond price should not go up as much. MBS price should not go up as much because call risk, that is the borrowers will repay money early, and hence even if market interest rate is going down, MBS price is not going up as much because people are foreseeing that by rate zyada gira, rate has fallen, so maybe people will possibly repay earlier. Okay, so this is regarding prepayment risk. If you are looking at, let us say over here, bonds from securitization of mortgage loans for residential property, there can be agency based RMBS. RMBS is residential mortgage backed security, or non-agency based. Non-agency based is virtually non-existent now. Earlier it was there, but after the global financial crisis of 2007, 8 and 9, the regulation is so strict that other than let's say a government backed body or an agency, uske alawa to get a non-agency backed MBS. Non-agency backed MBS would have let us say banks etc. doing this against, that is now not possible. Agency backed RMBS is usually issued by government bodies or government sponsored entities. So the mechanics are same. There are various mortgages which come together, make a pool, and against that pool there are various investors who invest money to get certain cash flows out of that pool. What are issued are mortgage backed securities. Sometimes a question might ask you to calculate the weighted average maturity. How do you calculate the weighted average maturity? You will take the number of years remaining in each of these mortgages. Let's say the number of years remaining are 10 years, 5 years and 7 years, and the amount is 100, 200 and 300. You will take the weighted average, 10 into 1 by 6 plus 5 into 2 by 6 plus 7 into 3 by 6. That will give you the weighted average maturity, as you can see over here. Similarly is the weighted average coupon rate, where in each of these bonds you might have a coupon rate of 5%, 5.5%, 6%. You take the weighted average. The weights are again the current values of the loans. They are taken as the weights. Okay. The pass-through rate is usually the mortgage coupon. So let's say the average coupon rate is 10%, service fee is 1%. So 10 minus 1, that is around 9%. So 10% is the average weighted average coupon rate, 1% will be the service fee, and hence 10 minus 1, maybe 9% is what I'm going to pass through. That is called as the pass-through rate. Okay, prepayment risk, as we have said, can be extension or it can be contraction risk. Now, when you look at CMOs, the two most common CMOs are sequential pay CMO or a planned amortization class CMO. Now, when you look at a sequential pay CMO, here there can be some credit tranching, like you will pay in sequence. Like for example, if I were to look at this SP of 1000 crores, they have 500 crores of tranche 1, 300 crores from tranche 2, 200 crores of tranche 3. You will pay in sequence. First money goes to tranche 1, then if excess money is there, then to tranche 2, then if excess money is there, to tranche 3. Like if the collection or recovery is only 600 crores, in which case first the entire 500 crores will go to tranche 1 and remaining 100 crores will go to tranche 2. Nothing will be there to tranche 3. Even tranche 2 will suffer some losses. This is called as credit tranching, sequential pay. You will pay in the sequence. So over here, this is called as sequential pay. Now there are also some other type of credit tranching, like planned amortization. Like you will have two tranches. One is called as the main tranche or pack tranche, planned amortization tranche, and then is a support tranche. So what I've said is, let us say for simplicity, out of every installment that is to be paid, 40 crores will be paid to the tranche 1, that is a planned tranche. No, but there is a lot of prepayment. I've got, let's say there are two tranches. Okay, let me just, I don't know, it's a little difficult to explain over here without numbers, but let us say there is a particular cash flow. You are expecting 100 in year 1, you are expecting 100 in year 2 and so on. Now we issue two tranches. Tranche 1 is the planned amortization tranche and tranche 2 is the support tranche. Now support tranche is like the balancing figure. Now planned amortization tranche, they have said that every year 40-40 will be given to them and the balancing figure will go into the support tranche. Like for example, if there is a lot of prepayment and in year 1 you actually end up receiving 120, well, in the future years you will receive less, but you end up receiving 120, then in the planned tranche 40 jayega, the remaining 80 will go to the support tranche. Or there is no prepayment. Forget prepayment, a lot of people are postponing, in which case you could collect money only up to, for example, 50, then 40 will come over here, only 10 will go to the support tranche, whereas the support tranche will be absorbing the balance. And if you are collecting only 30, then support tranche will get nothing, 30 will go to the planned amortization tranche. So this is a type of tranching where one tranche is sequential pay, you first pay tranche 1, then tranche 2, then tranche 3. In a sequential pay tranche, that is the case, but in case of a planned amortization tranche, what will happen is you will pay a fixed amount to the planned tranche and the balancing figure will be adjusted in the support tranche. Support tranche is bearing more risk and hence will have higher return, but it has a higher risk. Planned tranche is bearing lower risk and hence it will have a lower return as well. But there are other formats of CMOs. These are collateralized mortgage obligations. Earlier were debt obligations, can be general credit card loans, bonds, etc. Now you are specific to mortgage. So there is collateralized mortgage obligation. There is something called as, now these are other types, not very popular, but other types can come in an MCQ. So Z tranches, then PO, that is principal only securities, IO, that is interest only securities, floating rate tranches, and residual tranches. Residual tranches like equity tranches, you will get money as a balancing figure. So when I look at Z tranches, what happens is whatever is interest is accrued. So that is $100, there's a 5% interest. So whatever interest is there, it accrues. And thereby it gets added to the principal in the accrual period. Let's say over here the MBS is for 10 years, out of which the first 3 years is an accrual period. Every year ideally 5%, that is $5 had to be paid. So in the first year I did not pay $5, it got added to the principal. Second year I did not get, again it got added to the principal in the third year. So in a similar way, close to 115 odd would be the revised principal. And when it comes to the fourth year, when you start paying, then the principal would have been higher. So it is like saying that in the earlier years, in case of a Z tranche, like a zero coupon bond, you don't pay anything. So in a Z tranche, what will happen is, in the accrual period which is defined, you will not be paying any interest. However, whatever is the interest promised will be added to the principal, so that in the later years, the interest amount will be relatively higher. In a principal only security, what will happen is, you are investing in an MBS saying that whenever principal comes, money will come to me. Interest money will not come. You will invest lesser obviously, but yahan pe you will be very happy if principal comes earlier. So you have invested and money came back earlier, but in an interest only, you are saying that I will get interest only. But in that the risk is, if the principal comes back earlier, I am not going to get any share of principal, but if the principal comes back earlier, interest will automatically reduce. So an interest only holder will be worried if the principal comes back earlier. A principal only holder will be happy if the principal comes back earlier. It's a little complicated. So this is only principal payment. This is only interest payment. Floating rate is linked to a particular floating rate, and residual tranches are like the standard equity tranches. Okay. So this process of segregating like sequential pay, etc. is called as tranching. Describe the fundamental features of residential mortgages. Well, when I look at the features, there are two very important ratios that I try to cover. First is I look at the loan to the, so there are certain ratios that we look at. First, I think you look at the loan to value ratio. Like for example, if the value of the collateral is 150 and the loan is only 120, then there is 150 worth of collateral, out of which 120 of loan has to be paid. That is an 80%. Lower the better. Why? Because loan of 120 to be covered out of 150, well, I have some cushion. If loan was only, for example, 75 and the collateral was 150, it is best 50% here. But if the loan is very high, it comes very close to 150. Collateral is also 150, it's touch and go. Thoda collateral ka value idhar udhar hua and you don't have enough collateral for paying off the loan. So loan to value ratio, lower the better. Then there is a debt to income ratio, like how much is your debt installment, like an EMI in India as compared to the monthly income. So you take the EMI, that is the monthly debt installment upon the monthly income. So if your EMI is 50,000 and your monthly income is 1 lakh, 50% of your monthly income is going in EMI. Again, both of these ratios, lower the better. So when I'm trying to evaluate certain important ratios for looking at the quality of residential mortgages. I will say कि भाई ये mortgage का जो बंदा पैसा पे करने वाला है, what is his average income level? Well, 1 lakh. What is his average EMI? Well, 50,000. That means 50% of his income is going in EMI, which means if he loses a job, etc., or he gets a pay cut, very difficult for him to service. Or loan to value ratio, where they are trying to say that what is the loan amount? Well, that is 120 against a collateral security that they have given, which is worth, let us say, 150. Now, just for your understanding, there was a subprime crisis in the US in 2007 to 2009. So what happened is in the US over here is there are two types of loans. There's a recourse loan, a non-recourse loan. A recourse loan means that if there was a loan of 120, there was a collateral, value was 150. If the borrower is not paying, I can sell the collateral and get my loan back. But what if the collateral value drops? It from 150 it comes to 100. Housing loans had prices, housing prices fallen in the US. In which case, if the loan is 100, collateral is 100, I can sell the house, get 100 rupees. What about the remaining 20? In a recourse loan, you can collect the remaining 20. Most places in India, in Europe, there is a recourse loan, but in US, most of the loans are non-recourse loans. In which case, if the house prices fall, there's no incentive with the borrower to repay the loan. He will just give the keys to the bank. He will say, forget, take the house. Bank will now be staring at a $20 loss. They will say, मैंने 120 का loan दिया था, selling the house I can get only 120. I don't have recourse to the borrower. In which case 20 is a loss that the banker suffers. Now, usually when you give loans to people who have a relatively low debt to income ratio, so it is good. You have a low debt to income ratio. There is the low loan to let us say collateral, loan to value ratio, high credit worthiness. These are called as prime loans given to prime customers. Good credit quality, has good income, the value of house is sufficient to cover the value of loan. This is called as prime lenders. And then there is subprime. Subprime means they are having lower credit quality. EMI is a huge percentage of their income. The loan is a huge percentage of the collateral. These are subprime, and there's a lot of problem in the subprime loans that were earlier given. Okay, so there are a few other terms, like there is foreclosure. Foreclosure means you will have to close the loan early by selling the property. Can be recourse or non-recourse, as we discussed over here. Okay, so this is regarding various important ratios, and then you go into something called as just a second, is this covered properly? Yes, I think most of these areas are. Okay, then you have something called as commercial mortgage-backed securities. When you look at commercial mortgage-backed securities, we have studied largely regarding a residential, but for a commercial mortgage-backed security, the major feature over here is the fact that there will not be as many loans in a single pool in a commercial mortgage-backed security as compared to the residential. Residential will be small borrowers taking one house, but in a commercial property, maybe someone is taking an entire building, an entire floor, and hence I will have a few loans. Usually, the number of loans will be lower in that pool as compared to the residential. Secondly, largely the cash flow that is earned in the form of rentals. So over here, I may be a real estate investor. I will take a building and I will give parts of that building on rent to different people, and hence I will get certain rental yield. So over here also you will take those ratios, but when you calculate cash flows, you will take the rental income minus the operating cash flows minus, let's say, a charge for depreciation, etc., for the wear and tear, and that will be the cash flow which will be considered for the purpose of servicing the debt. So commercial mortgage-backed security, MBS is backed by income from real estate. Debt to service coverage ratio will be the net operating income. How do you calculate net operating income? Rent minus cash operating expenses like maintenance, housekeeping, cleaning, etc., minus non-cash replacement reserve like a depreciation. So this is net operating income divided by debt service. So how much is to be paid in terms of debt service? That is one very important ratio for a commercial mortgage-backed securities. Other ratios like loan to value ratio, debt to income ratio still continues to be evaluated. The call protection, like in case of a commercial mortgage-backed securities, also there is kind of a call or a early payment risk. How can it be protected? It can be protected at an individual loan level, where in the loan there can be a prepayment lockout where you can tell the corporates that we will not allow early payment in the first 5 years. Or there can be, let us say, a prepayment penalty. In India, Europe, prepayment penalty is common. In US, it is not as common. So they will say that we can add a prepayment penalty in percentage if you are paying early. Or there can be something called as a defeasance. Over here, what happens is, instead of they prepaying money, we will open a separate account for them where they can deposit that money into a government bond, and that money will earn interest. And using that, they can pay at the scheduled dates. So rather than telling them that you have money, we will open their account, we will try to invest their money in the government bonds, and we will not utilize that money towards my loan repayment. We will take this towards a, let's say, government bond. So that ways, these are the three routes: prepayment lockout, defeasance, and prepayment penalty. There can also be protection at the CMBS overall level by tranching, like a sequential pay, planned amortization, etc. Now, there is something called as a balloon payment and a balloon risk, which is very unique to a CMBS, because usually in case of a mortgage backed, especially residential mortgage backed security, the payments, the installments happened in a uniform manner throughout the life. However, in a commercial borrowing, what they are saying happens is, if there's a 100 rupee loan, let's say over 5 years you have to pay, then you will not pay 20-20 in each year. You will pay 10-10-10-10-10 for the first 5 years, and then a balloon payment is kept at the end. That is at the end. So there is a possible balloon payment which comes at the end, and hence there is a balloon risk, because if that payment kind of gets affected at the end, then there is a lot of risk. So over here, that is a separate risk which is unique for a commercial mortgage-backed security. Now I can understand that we have tried to cover this in about 3.5, probably 4 odd hours. So doing fixed income over here in such a short span would be a little challenging. So we have tried to give you basic essence in terms of certain areas where you want a quick refresher. So I hope this video helps. If you want a detailed understanding, we'll try to put detailed videos for these individual topics. You can also write if you want specific videos for a specific topic. And if you have liked this content, I would be really happy if you can just press the like button. You can subscribe to our channel for more such content, and that will mean the world to us. Okay, so that should be it. I hope fixed income becomes a little more easier to you after this video. I'll see you soon with more such videos. Till then, study well, study hard, good luck, and take care.